Market is opening here in Europe this morning, and expectations low for any huge movement at the start of trade. It's been a much quieter session in terms of corporate earnings than we've seen of late. We spent the last 2 days covering earnings story after earnings story. It's a little quieter today, and out of the blocks, we've got the FTSE 100 really quite flat, which tells you something. The stock 600 then flat so far, waiting for the CAC to open, waiting for the DAX to open. And yesterday, even at the end of the trading day, we were actually we were 50-50 in terms of the sector performance. So it was a day that was sort of difficult to describe.
It was Thursday. That's how I would describe it.
That's safe.
That's safe. Immerse is up by 4.5%. So it's coming through and delivering on the back of those numbers. The market likes what it's hearing. Caring continues to rise. So it's up by another 1.2%. I need to check on what's happening with AP Immerse. But it's a luxury on the front foot in Europe once again. I've yet to see a number on L'Oreal. I want to see what the number on L'Oreal is.
Yeah, just while you're looking for that, the commentary coming out of the Bloomberg intelligence team around Immerse saying it's in a high luxury league of its own, and this points to the conversation we were having about super premiumization, ultra premiumization, the pricing power that goes along with that, and we see that very much indicated in the markets today, and that's one of the reasons why the stock is up by 4.75%.
Yeah, in the meantime, you were talking about Immerse, Guy. You're already seeing a little bit of a bounce back, but it is still nothing compared to the 12% plunge that we saw yesterday. So it's a bounce back, but it's not perhaps a stock that's going to be very volatile in the future.
Pre-market, I saw L'Oreal down, let's call it 6%. I've got a halt on my screen at the moment. So it's going to be interesting to see how much pain that stock experiences and how much that's going to weigh on the CAC 40. That's very much a China narrative. So it's interesting that Immerse is not doing that well out in Asia, but the US story is so strong. L'Oreal has been really dinged up quite badly by what is happening out in Asia, and that lack of travel seems to be a big factor.
So the Asia story for L'Oreal is a negative one, as we've discussed. The US one, as you've mentioned, in conjunction with what we're seeing in Immerse, is strong. Also, as you referenced before the break, Guy, dermatology being strong, and this being seen as a real boom area, in particular in a younger demographic, and there's a sort of TikTok trend towards caring about skin and dermatology and that sort of thing, that might attract regulators at some point, because you're talking about some quite young people buying skincare products.
By the way, just to be clear,
I was about to say, what is your product recommendation, guys?
When I say skincare matters, I'm basically parroting Alex Steele, who has spent the last 4 years laughing at me.
Yes.
Because I think it doesn't matter, but she apparently does, and I am apparently wrong.
You got to start early, absolutely. But very quickly, I want to mention that you do have Ubisoft actually coming out of the gate higher by almost 9%. That is a massive move for the stock.
You're now a gaming correspondent.
Yes.
That's it.
I mean, I'm adding it to the portfolio of server chips. It's nothing compared to your Taylor Swift correspondent.
He's a Taylor Swift obsessive. That's different.
I know.
I'm a Taylor Swift economy obsessive. Taylor Swift being emblematic of this.
You want that title? We'll give it to you. We all know it's really true. But I also mentioned that Unilever, to your point on the Immerse kind of having a bounce back, Unilever is having an opposite reaction, outperforming yesterday. Now it is one of your biggest weights on the stock, on the FTSE 100.
Let's get to some of the French earnings stories of the morning, because there are a couple of them. We've talked through some of them this morning. So let's get some analysis. Bloomberg's Caroline Conan joins us then from Paris. Talk us through your thinking on the Immerse numbers then. Looks really strong, Caroline. What did you make of it?
Hermes, as you were mentioning, is almost like an outsider in the sector. If you look at the fourth quarter, sales figures were up 17.5%, beating estimates. Most of the regions were up above 10%, including the US, including Europe, and including, of course, the key market of China. They've outperformed, as you know, most of their peers in the luxury sector over the past year, the stock gaining 34%. So today they're actually saying they're going to give an exceptional dividend of 10 euros a share. If you look at Hermes, you were talking about ultra premiumization. This is what analysts are looking at. Even if you're trading luxury, you're spending less on luxury goods. Usually the Chinese consumers is actually trading up and buying this one piece of luxury that actually conveys status, and that's actually usually Hermes. Hermes has become, according to Barclays, for example, the second most desirable brand in China after Chanel. So clearly, it's all about scarcity, exclusivity, and desirability of Hermes.
I was just trying to work out how many shares you'd have to have, given the dividend, to buy a Birkin bag, but we'll leave that calculation for a little bit later. L'Oreal's just opened.
It's about
Caroline, took a while
$10,000
to get going. Yeah, it's a lot. I think, yeah, it's a lot. It's yeah, and they go up from there. L'Oreal is dropping pretty sharply right now. It's actually just dropped off the end of my screen, which tells you maybe something about just how far it is down. We opened up down around 6%.
Now down 7.
Now down 7. There you go. It's at the bottom of my screen. It's dropped off 7%. Maybe it goes lower. Why is the market caught so by surprise with what L'Oreal has said this morning? What are they telling us that is the surprise here?
I mean, we're talking about Hermes. Of course, Hermes has huge pricing power, and L'Oreal is more consumer products. So obviously, the stories are very different there. And if you look at the story in China for L'Oreal, they are suffering a lot from new scrutiny on travel retail. You know, the Chinese, they have this practice called daigou, where they actually buy products, luxury products, when they travel on behalf of other people. There is more scrutiny, more regulation on this practice. And that's having a lot of impact on travel retail, which is huge for L'Oreal, especially for their luxury products division. That is the skincare like Lancôme, Kiehl's, but also the fragrances, Yves Saint Laurent, Giorgio Armani, for example. So this division has been impacted in China and in travel retail. There are some bright spots, however, for L'Oreal. For example, the US did better than expected. Revenues up more than 9% in the fourth quarter. Europe also had double-digit growth in the quarter. And if you look at the dermatological division, it's also going very well, with revenues up 27%. These are brands like CeraVe, La Roche-Posay, which actually are big successes among the younger generation. So clearly, customers there as well are also choosing perhaps less but slightly more expensive products. Still, even if the investors are reacting pretty badly for L'Oreal this morning because of that bad numbers in China, because of North Asia, revenues down 6.2%, it's still not as bad as the story we had at Estée Lauder, for example, in the US, their main competitor last week, where they announced job cuts of 3,000 people.
Caroline, let's macro this out if we can. If luxury, from a market cap perspective, is the European Mag 7, how resilient is that when we're talking then about simply this idea that you are seeing American resilience hold up some of these companies' numbers? How long does that last?
Yeah, and of course, some analysts are a bit more careful about the first 6 months of the year. For example, if you look at the consultancy Bain, they're expecting the luxury industry to grow by about 4% this year compared to 8% last year. So, of course, this is going to impact some of the brands, even though some of the top players, as we were mentioning, like Hermes, like LVMH, which has 75 brands, are showing some resilience. The story in China is still difficult. The aspirational consumer, this consumer who doesn't buy luxury products on a daily basis, is impacted by the environment, the concerns about inflation persisting, and of course the real estate situation in China. So the 6 months of the year, of the beginning of 2024, will still remain a little challenging for the sector, except for some outstanding players like Hermès.
Caroline, thanks very much. Bloomberg's Caroline Conan joining us there from Paris. Let's get a check on some of the individual stocks on the move. And just because they're moving quite a lot at the open, worth recapping where we are on the luxury names, the French movers there we were just discussing with Caroline, but there's a lot going on outside of that as well, Joe.
So we're seeing Hermès up around 4%. Caroline was going through some of the main points there. It is a beat on expectations for the massive maker of Birkin handbags. So that is what's driving that stock today. But we've also brought up Kering because we're seeing positivity in the broader luxury space, but also some trader contacts of mine telling me that there is a broker move on that one. So we'll wait to confirm that one on the terminal for Kering. But L'Oreal down 7% or a bit more, 7.5%. Now, this is also a luxury story because the luxury end of the business is where it's weaker in China. HSBC has a note out today saying that luxury spending by Chinese travelers is still down 20% versus 2019 pre-pandemic levels. So that is the weakness in that area, and we're seeing that one down sharply this morning. Then in terms of those video game stocks, we will flip over and have a look at them. You mentioned Ubisoft gaining there. That really was a single stock story in terms of the guidance about a downgrade to their forecast, some strength in the pipeline coming through. Short interest in that one is high, so up 15%, a big move for that one. Then we'll flip over and have a look at a couple of others. We're going to take a look in the car space first. I believe we're going to go to Renault. Now this one, it is declining. Nissan over in Japan, a drop in sales, a massive fall for that share price. Renault remains the largest shareholder in the company, so we're seeing Renault weakening as their partner Toyota does actually relate to that as well. Both of those firms seeing a decline over in Asia and therefore feeding into Renault as well. Then another one we haven't done yet, Delivery Hero, just quickly on this one. Fears of competition over in Asia. Two of their biggest rivals are merging, according to a Bloomberg exclusive. That's in the food delivery space, and as such, that one continuing its bad run, down around 3%. Then a couple of morning calls for you. Handelsbanken gets a sell over at UBS. They had good results out this week. Net income remaining high, but their wealth business weakening. So that one does come down after a bit of a share price rally for that one. And finally, Unibel, the owner of Westfield, the shopping centres. Again, good results from them, but that stock up 45% in the past couple of months. So they are downgraded to hold over at Jefferies, and that one coming down 1% today.
Joe Easton from our equities team, we thank you so much for walking us through some of those movers. Coming up on the program, we go from stocks to credit. Alexandra Ivanova joins us from Invesco next. Stick with us. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Yeah, I think that given our capabilities in private credit, in alternative credit, and just given the amount of liquidity we have, I think that we are a natural partner for any bank that's looking to reposition its asset mix.
Yeah, Ares Management CEO and co-founder Mike Arrighetti, they're talking about private credit. Let's stick with the credit theme. We're joined this morning by Alexandra Ivanova, fund manager at Invesco, on set with us here in London. Very nice to have you with us, Alexandra. Nice to have you on set. So let's get your broad perspective on credit markets. I think you're overweight credit, but you're also saying in your notes ahead of our conversation today that credit fundamentals are still reasonable, which doesn't sound like a ringing endorsement. So tell me your perspective on credit at this point.
Yes, you're right. I mean, the credit spreads have tightened aggressively, especially in the last quarter of 2023. And I think the valuations are screening quite expensive. But this is an asset class that actually pays to wait. You do get your carry, you keep your coupon, and also, given the macro uncertainties, you can, within the credit market, you are able to position yourself defensively, but still get your yield.
Got the chart there. That's high yield credit in America. That's high yield credit in Europe. Spreads are tight. How much tighter can they? We've got the S&P at 5,000, and I got high yield credit spreads at super tight levels. How much further can we go on the upside and the downside in terms of those? Is it sense on the upside in terms of how much tighter we can get? Is the risk? I'm just trying to work out what the risk is. Is the risk that I'm going to pick up a few more cents on the upside in terms of what I'm picking up, but the downside potential for those spreads to widen out is much greater? So how asymmetric is the risk right now?
So I think you're right. I mean, it is quite asymmetric because if you look at the actual absolute levels, we are very, very tight. There is also another measure that we look at is the spread as a percent of your total yield, and that measure looks very tight. So in that sense, I think that there is a risk that we can widen out from here. So in general, I think if you stay with the short duration credit, that's fine. You have higher yields on a risk-free basis, and then you add up a couple of basis points or 100 basis points of spread on top of it, you get good yield.
Am I really being rewarded? I'm front end of the curves kicking it out for me right now. You're getting a decent yield at the front end. Why take the risk and buy and take that? Why take the credit risk on top of the govy risk?
So why would you take duration risk in credit is probably because you're still waiting for that rate cuts to come through. And while you're waiting, you're actually getting paid, right? So that's part of the credit market that makes me feel quite comfortable in a better quality part. Don't go out reaching out to really levered names. Having said that, I do have some preferences in high yield market as well, even at these levels. But in general, the credit fundamentals are, as I say, they're reasonable. The net debt is coming down. Yeah. Interest coverage ratios are coming down, but still elevated. Yep. It's on aggregate. And credit technicals are very, very strong. So what we have seen is a lot of inflows into credit markets from the beginning of the year. And a lot of fund managers like ourselves are sitting there and waiting on the sidelines, lots of cash to deploy. And the new issuance has been quite robust in the first month of the year. And we're still able to absorb all that.
Well, the resilience in the markets, in the economy, is something that it feels like is blindsiding economists, strategists, investors, you name it, and frankly, us as well as journalists. But talk to us about the fallen angel risk here, because it feels like one of the concerns going into even some of the resilience we saw prior to this iteration was that perhaps there's some sort of zombification of the economy, perhaps that flushing out that is so traditional of recessions. If we get no landing at all, where do we kind of get that clean slate from? Are you worried about that?
So, yes, I do. There are sectors, and maybe if you think about, for example, banks that have commercial real estate hidden around
we were
somewhere.
Just going to go there, Alexandra.
Funny that.
Thanks for taking us there.
Tell us more.
Well, it's we just don't know all the details. Commercial real estate can be very good. It very a diverse set of assets in there. So you have seen some fallout in individual banks, for example, and I'm sure if that actually turns out to be true, then we will see downgrades and fallen angels that you've said. But we also have on the other side rising stars. So companies like Ford, they have been downgraded during COVID. They have come up. They've left high yield market. They still look attractive, but they're on the way improving their credit quality.
So that's some of the areas you see safety. Just back on the commercial real estate theme, though, you said there's no transparency. What is it that we're missing? What do we not know?
So transparency in reporting in banks, for example. We know that some of the banks have U.S. real estate exposure. Where is it? Is it the prime location? Is it the better quality real estate? We don't know. And the market is first sell, then ask questions, basically. And so you have to be careful. You need to know, maybe stay with the national leaders in terms of your exposures.
How bad could it get? So there's a great quote. We've got a story on the Bloomberg this morning coming out of Man Group. And here's the quote that you get. If each of these banks takes a 15-cent write-down for every dollar they lend to commercial real estate, which I'm not saying is the base case, but is a completely reasonable scenario, not only are these banks not investment grade, they're insolvent. How big a risk am I taking buying bank bonds right now, given the lack of transparency that you're talking about? These are obviously geared trades. They lend out to CRE on an interest-only basis in certain cases, in many cases, and therefore they're taking a lot of capital risk. Should I just avoid the banking sector in terms of the bonds right now? Or if I'm careful on the single names, I know what I'm doing. But you're making the point that transparency just isn't there at the moment, and pricing isn't there either.
So you're absolutely right. It's all about single names and idiosyncratic stories. Do your fundamental analysis. Stay with the large, well-capitalized banks, and they're paying you very good yields on their bonds, and their exposure is so much more relatively lower than relative to regional and small banks.
Okay, Alexandra, thank you very much. Thanks for joining us. Alexandra Ivanova, fund manager at Invesco. Great to get into a credit conversation, so thank you for being with us this morning. Let's break down some of the stories, some of the biggest stories in the UK news. The Markets Today blog specialising in covering those for us. Sophia Walter-Acosta joins us from the blog team. Sophia, where do you want to start? I'm going to defer to you on this one. We've had a few UK themes out this morning. The Chancellor talking last night at the City UK event that I was at, talking about, saying that he wouldn't answer questions on the possibility of a British ISA because he can't talk about things that might be in the budget, which kind of gives us a little bit of a clue as to at least what he's thinking about right now.
Yes, exactly, Anna. And he did say he was he thought the idea at least was very attractive. I mean, this really goes to the problem of how do you get more capital from the UK. The UK does have a deep pool of capital, but it's not invested in the UK stock market. And this problem is a historical problem. A lot of that UK money has actually shifted to gilts in recent decades, and there's a reason for that. And if you look at the yield on gilts right now and you compare it to dividend yield on the FTSE, the FTSE just doesn't offer enough of a reward for that. Yep. But he suggested, that the British ISA could be an idea here. That's a tax-free individual savings account. But there's so many structural problems in the UK stock market, and years of underperformance is one of those. You can fix all you want on the supply side. You can make it more attractive to list. But if the FTSE 100 and other UK indexes have a history of underperforming the rest of the world, that's really, really hard to shake off. And Guy, Anna, and Kriti, the FTSE 100 last year underperformed the Euro Stoxx 50 by the most since 1999.
This is and I understand that the Prime Minister has an issue with this, and maybe this is part of the issue. And Sophia's talking about this. You're basically encouraging UK investors into an underperforming asset. Do you want to be doing that? You're trying to make an investment decision for UK investors that maybe they shouldn't be taking.
Right, there's a lot going on ahead of an election as well, isn't there? There's that, there's the possibility of this British ISA, there's also the possibility that the government might be selling one stock, and that's NatWest in particular. Yep. And what's the sort of political risk around, talking favourably about the idea of share ownership? How does that play out along with the political horizon? So I was out at this event yesterday, Sophia, where the Chancellor was talking about these themes, and he was also talking about Britain and tech and attracting tech listings. He was saying he wants the London Stock Exchange to become Europe's NASDAQ. I'm sure lots of stock exchanges around the world would like to become somewhere's NASDAQ, but they can't all do it, I suppose. How is the conversation developing then around listing in the UK at this point?
I think that's a very, very timely comment. If you look at what happened yesterday with ARM Holdings, and that was a very high-profile loss for the UK last year when a Cambridge-based company, a very high-profile one, chip designer, opted to list in New York instead. The stock rose more than almost 50% yesterday and added $38 billion in value. I just want to kind of give a size and scope, some context around how much that is. A single day increase for ARM, that was more valuable than what Barclays is worth, what Rolls-Royce is worth, what Lloyd's is worth. So the UK really doesn't want to keep losing these high-flying companies to the NASDAQ. I mean, as you say, Anna, that's kind of an aspiration that a lot of countries will want to have their own NASDAQ. But the US just is so competitive on that front. It's a much more attractive market for companies because the listing rules are quite lax there. And it's also, it's attracting so much capital. The US has the deepest pool of capital in the world. You can't compete with that.
Sophia Horta-Acosta from our Markets Today blog, we thank you so much for that content. You get more from her and the team on the front page of the Bloomberg UK website. All you got to type in is TLIV Go on your Bloomberg terminal. Coming up on the show, we pivot to geopolitics. Stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Markets Today. We're about 30 minutes into the European trading day. You're seeing some mixed pictures. There's some real outperformers. Ubisoft, for example, is the one that's catching my eye this morning. But then you also have some real losers as well. L'Oreal, for example, not doing as well. And it really seems to be this theme of, do you have those kind of single stock winners? Or how much of the geopolitics play? Does the China story matter? These are all the questions we're asking. Net on the Stock 600, though, you're virtually unchanged right now. So again, I would call this a little bit of a nothing burger in the context of the week that we've had. But we've been talking about this kind of global read through as well in terms of geopolitics and whether or not the Chinese consumer matters, whether or not the foreign policy story matters. Yep. And I think we've come to the conclusion that in the last 24 hours, perhaps the biggest line on the geopolitical front came out of Russia.
The Tucker Carlson interview, which I think is probably in my view, is a bit of a stretch. He didn't push Putin. He was never going to push Putin. But I think the lines that come out of Putin that really strike me out of that is that this is going to be a long-term story. This is something we're going to have to live with for quite some time. And it fits as well with the narrative of what's coming out of the Middle East right now. That feels like, when we were talking about Immerse a little earlier, that's something that's going to last for a long time. And then you plug Taiwan into that story as well. So this geopolitical story is not going away. It's going to be something that you need to, over time, kind of start to price in. Let's hear from that interview, because I think it is worth playing a little bit. Vladimir Putin basically indicating that Russia thus far has not achieved its objectives in this war. We are remember nearing the 2-year mark, and the hint is basically this is going to go on for quite some time. So the Tucker Carlson network, Tucker Carlson sitting down with the Russian president, talking about the fact that maybe he would consider negotiations, but here's the catch: only if the US stops supplying weapons to Kyiv. The Russian leader basically has also overseen the jailing of several American journalists, most notably from the Wall Street Journal, giving his first interview to Western media since that invasion of Ukraine.
What we are conveying to the U.S. leadership, if you really want to stop fighting, you need to stop supplying weapons. It will be over within a few weeks. That's it. And then we can agree on some terms.
Okay, joining us now to discuss this, Bloomberg EMEA News Director Ros Matheson. He talks about negotiations. He's not really talking about negotiations. He's basically saying, you stop supplying them with weapons, I can do what I want in Ukraine, and then we can talk.
Well, that's right. In a way, he's trying to flip the narrative on his head. He's saying this war could be over in a few weeks, the war he started, by the way, if only the US would stop supplying Ukraine with weapons. Does that suggest he's serious about negotiating? Probably not. What he's saying, he's trying to intimate that he's not the one holding up a solution to the conflict again that he started, that it's Ukraine and the US that want to propagate the conflict into perpetuity. And what he's saying again is if the US would only stop supplying Ukraine with weapons, he might be willing to consider negotiating. Of course, is he serious about negotiating? We have no idea. Would he want to negotiate? We have no idea. Does it benefit him to negotiate? Possibly not, because on the ground in Ukraine, you know, he's making some progress. He's certainly managed to grab and hold a fair bit of Ukrainian territory in the south and the east. He's not taken the entire country, but certainly he's degrading the Ukrainian military alongside his own. They're running out of weapons and ammunition. Can he persist and perhaps mount a fresh offensive, you know, later this year? So is it in his interest to negotiate? We don't know. What he's probably doing is trying to exploit some of those fissures that we're seeing now in the discourse, as you say, about is this war going to go on to the point that Ukraine should negotiate?
And of course, it's coming in the context then of the congressional funding really just falling apart, a bill that was bipartisan that President Biden was really hoping would get that additional Ukrainian aid and aid, by the way, to Israel as well, again, falling apart at the seams. So I wonder how much of that colored that kind of context. In terms of negotiations, he made some interesting comments in terms of hostages. We're waiting for updates on where kind of progress might be made on the release of the Wall Street Journal reporter. And he actually indicated that there may be something on the horizon, at least, or some thought that might lead to it.
Well, that's right. I mean, he started out by saying that he felt that Evan Yurskovich had actually stolen state secrets from Russia, which there's no evidence that he did. But he intimated that he might be willing to look at a prisoner swap because Russia's been trying to get a hold of this chap who's in jail in Germany for murder for quite some time. And he's been in the mix in various other prisoner swaps that have gone on between Russia and the US. But there's no sense that Germany, for example, would be willing to give him up as part of this. It's not just the US can agree to this and make it happen. Germany has to say, we're okay with releasing someone that we tried, found guilty and put in jail in Germany for this. So is it likely anytime soon? Possibly not.
We've seen this playing out. The war in Ukraine is playing heavily into US politics, and that's frankly why Tucker Carlson is there talking to President Putin, isn't it? Something else that's playing strongly is conversations about, you know, who's fit for the job when it comes to leading the United States. President Biden and former President Trump, both pretty old by historic standards for this role, but it's a focus on the abilities of the current president that's very newsworthy over the last 24 hours, Roz.
Well, that's right. And looking back, maybe this is one of those very consequential weeks for Joe Biden in his campaign for re-election. Of course, we're months away from the election, but the narrative is just escalating increasingly over Joe Biden's age. Again, not much older than Donald Trump, but about his mental capacity as an elderly man to do another term in office. And it's compounded by a series of gaffes that we've seen, a number of things over, you know, the past months, but particularly in the recent weeks, mixing up the names of leaders. And, you know, most acutely in the press conference where he came out to criticize the DOJ report, to say they were going too personal with their attacks on his mental capacity. Then on his way out, he mixed up the leaders of Egypt and Mexico. So that just adds fuel to this sort of narrative for the Republicans, and including Donald Trump again, you know, who can attack Joe Biden and say he's not going to be able to last another 4 years.
And thinking about the Republicans, I mean, Trump, it seems to be on his way, of course, to closing in on the Republican nomination. But talk to us about the Supreme Court and latest efforts there by some to ban Trump from the ticket and by others to defend his ability to contest. Where are we on that one, Roz?
Well, that's right. The most recent one, of course, is this hearing of arguments on whether the Supreme Court should look at the Colorado ruling and whether that should apply to other states that say that, in essence, Trump committed insurrection with the Jan 6 attack on the Capitol, and whether he, allowed that to happen. And so the question is, does Colorado apply everywhere else? And it seems initially from the arguments we heard yesterday that the Supreme Court justices were kind of querying that. Can you take what happens in one state and apply it everywhere? So, of course, that ruling is some weeks away, but indicating for now that they're not going to, insist that is applied across the board.
Roz, great stuff. Thank you very much indeed. Bloomberg's Roz Matheson. She brings up the interesting point about the prisoner exchange. Olaf Scholz is going to the United States, is in the United States right now. He's going to be meeting the president a little bit later. So Olaf Scholz, President Biden, D.C. today. What's going to come out of that? What is the takeaway from this? Is it all geopolitics? Is there some trading there as well? Let's get more on what is happening here. Ben Sills joins us now from Madrid, managing editor for European Economy and Government. What's the objective? Let's talk about it from a German perspective. Ben, what's the objective for Scholz and his team when it comes to this trip?
Well, I think that the Germans are feeling slightly isolated at the moment, as you know, many of the Europeans are, because of this gridlock in DC over the aid for Ukraine. The Europeans also struggled to agree on their latest package of financial support, but they got that through at the start of this month. And I think, in theory, the idea from Scholz is that by flying to Washington, he could help Joe Biden to unlock that gridlock in Congress and get more weapons, more aid flowing to Kyiv.
Ben, there's a lot of questions, as we just talked about with Roz Matheson there, about the viability of Biden on the foreign policy front. Realistically, how do we end this?
I think the challenge is that the scale of the war probably goes beyond the U.S. presidential elections, which just inserts this tremendous amount of uncertainty in anybody's kind of strategic planning. There's an awful lot of anxiety here in Europe, both in Kyiv and in the other European capitals, about the consequences of the way U.S. policy may shift if Trump wins. But even before then, you can see, Biden is struggling to deliver on his word. He promised Zelensky that the money would come through. He's failed to deliver on that so far. So even now, several months before November, the ability of the U.S. to act as a kind of leader for the Western alliance supporting Ukraine is somewhat compromised, and that leaves the Ukrainians in a very difficult position on the battlefield. And you can see from the interview last night that Putin's tail is up, and he feels like he has the upper hand at this moment.
So geopolitics certainly part of this visit, Ben. What about on the trade side? We've been reporting this week that Europe is preparing for a transatlantic trade fight with Trump. Now, that's not necessarily what the two gentlemen who are going to be meeting today are going to be talking about in Washington. But in terms of European preparedness for that, I was talking to one company this week that was discussing the possibility of a Trump president using the lever of LNG, and where does that leave Europe? There's a sense, perhaps, that Europe is starting to prepare on many fronts.
100%. Our guys in Brussels were speaking to sources this week who said that the European Commission is actually starting to draft an impact assessment of what a Trump presidency might mean. Having said that, the transatlantic relationship, even with Biden in the White House, is not in great shape. They have failed to reach a proper agreement to roll back permanently the tariffs which were brought in under Trump. And the Europeans do feel that the U.S. administration is somewhat unsympathetic to their concerns, particularly on trade, and that America First philosophy, which really was obviously introduced under Trump, has nevertheless remained an important force in U.S. trade policy in particular throughout the Biden administration. So the Europeans aren't comfortable with this at all.
We're going to have some great coverage coming up of this trip a little bit later on, both here on Bloomberg Television and, of course, on the Bloomberg Terminal. Ben, have a great weekend. Thanks for stopping by. Ben Sills joining us out of Madrid on what we can expect from Olaf Scholz's trip to D.C. What are we going to talk about next? Vegas getting ready to host America's most watched sporting spectacle. I'm glad that story talks about the fact it's America's most watched sporting.
That's hard to say.
It is. It's on at like 2 o'clock in the morning.
Say this next sentence.
Anyway, we're going to discuss Super Bowl spending. This is a Taylor Swift story as much as anything else, but Taylor Swift is just emblematic of the spending story that US consumers are delivering at the moment, which is absolutely amazing. It's a relatively small stadium, so actually ticket price is really high as well, so you can't get the seats. But it's on the Strip. First time the Super Bowl is on the Strip. We'll talk about that next. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asins is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is really the result of strategies that were put in place a number of years ago that are now just really starting to come to fruition. A lot of folks, as you said, didn't really understand the company well and where we fit. And obviously we had a lot of growth attached to the smartphone market, but ARM is in a lot of devices that people may not naturally think about. We're in a Tesla vehicle. We're in a Ford F-150. We're in a Ring smart camera. We're in a Samsung TV, a Samsung smart appliance.
That was, of course, the ARM CEO, Rene Haas, talking to Caroline and Ed on Bloomberg Technology. Fascinating to see just the bounce we saw in that stock has so many different narratives that spin off it, one of which is the AI story is now firmly embedded into the ARM story, which is fascinating, and where they go with that and what impact they will have in terms of your specialist subject, which is server chips.
I am server chip correspondent on this show.
Yeah, and gaming correspondent.
It sounds like.
Gaming correspondent, and apparently cannabis correspondent as well.
Yes, throw a little PepsiCo in there. It's a fun mix.
It's quite the mix.
It's the Super Bowl.
We'll talk about
We're
that.
saving that.
We'll talk about that in just a moment. Don't go there too early. But also, I think there's if it had listed in London, European stocks have done nothing this week. We've had a whole slew of earnings. And basically, they've all cancelled each other out. And if you look at the week chart, we've gone absolutely nowhere.
So it was really fascinating, that statistic we were hearing from Sophia Horta-Acosta on the Markets Today blog earlier about the jump in the ARM share price yesterday being bigger than the market cap of so many big banks here in London. So just to your point, Guy, just to underscore what London missed out on by not being able to recapture ARM, because we remember covering ARM.
This is a Cambridge-based company.
And they used to be listed here, and we remember covering them and talking to the management of that business over the years.
Anna's basically calling me old here, but we'll park that for a moment.
Both of us. I'm really not very much younger. So we're talking about that. I just want to linger slightly on the AI thing, because I did speak to another CEO this week. You know those businesses that have been in AI for a long time, but AI wasn't as exciting as it is now. It's generative AI that's really got everybody suddenly also buzzy about AI. And there are some businesses that have been in AI and they say, yeah, sure, it's the biggest opportunity of a lifetime for some people. But for others, we've been doing this a long time, and you could have said the same about all kinds of other
These companies need better PR.
I mean, this was Microsoft's entire point, right? With the whole open AI story. They're like, well, we've been invested 49% stake for ages. But to your point about the kind of listing in London, would we have then, hypothetically, let's play like fantasy day for a second. If it was listed here, would we see a 60% increase in one day? So
that's
is
a
the
good
hype
point.
Translated to this side of the Atlantic.
Are US investors just more attuned to this narrative?
I mean, that's why you go stateside, isn't it? That's the narrative you hear anyways. You go there because they understand how to value tech companies, they know how to write research on tech companies, and there's the bigger pool of liquidity. But that is what London is trying to fight back against, and I was at that City UK dinner just to make that point.
And I went out last night.
I did. These are the risks I take for the team.
For the job.
Yeah, thank you very much. You can thank me later. But hearing the Chancellor talking about how they want the London Stock Exchange to be Europe's NASDAQ, they want tech businesses anywhere in Europe to come to London to raise capital.
But if there is this hype, to your point on the generative AI, and if there is this kind of there is a fundamental, this is the future, this is kind of the early investment you get in on now that's going to really pay dividends later. Is that the same narrative that would show up here? And I'm just not convinced it is.
No,
I don't think
luxury.
The hype exists.
We have luxury, which is
around the Birkin bag.
Around precisely.
There's the hype,
That's where the hype's been, and certainly has been over the last few years.
Yeah.
Mixed story coming out of Europe, I would argue, this morning. L'Oreal certainly suffering as a result of what's been happening in China. Birkin continuing to sell very well in the States, so Hermes has had a great time. LVMH's numbers actually continue to be okay. There was some concern around LVMH recently, but again, in the States, it's doing okay. And actually, L'Oreal's doing okay in the States as well. And that comes back to this ongoing strength that we have in the US consumer.
Yeah, and that's actually maybe the surprise of some of these earnings stories this season, that we were expecting weakness in China, and we saw that coming through in some of these luxury reports just this morning, and the L'Oreal numbers from last night. But it's the resilience of the US story that maybe has been underappreciated all of last year from a macro perspective. We spent time underappreciating.
We thought we were going to have a recession.
Yeah, where is it?
We haven't had one.
So when we're talking about what's kind of supporting this European market right now, we're talking about American resilience, and we're talking about buybacks and dividends. That to me does not sound very structurally safe at the moment in terms of investing into this market. So my question here is, when does kind of the rubber hit the road? When does the kind of reality check, the reckoning happen for the Stoxx 600?
I think you're already seeing some of it, a lot of it being represented. The underperformance we're getting, London certainly has been continuing to underperform. I think some of that's already there. I'm also fascinated to how stock markets plug in the kind of the geopolitical risk, not the geopolitical risk, the political risk that exists in Europe, and also just this German economy that's just like this hole at the center of Europe that is acting as such a weight at the moment.
Well, Christian Lindner is going to be here in the UK next week, so we'll probably hear a lot more about the German economy. Thinking about things that are ahead for us, and we can put up a graphic that shows what is on the sort of trading calendar. One of the things that stands out, and we started the program talking about why this is relevant, is this CPI revision out of the States. Normally we get excited about CPI prints, and we'll get that from the States next week, won't we, with US CPI Tuesday, UK CPI as well. So inflation always in focus. But the revisions seem to once a year take on a sort of life of their own, and we were reminded by the Fed how much damage this did to our inflation expectations last week and our ability to assume that we can keep bringing inflation down. Last year.
So this time last year, the revisions basically unwound the disinflationary trend that we thought was in place and wasn't. So if we see that same story again this year, I wonder whether it shows up now or whether it shows up later, because I think what we're seeing at the moment is a re-acceleration in the US economy. And this is not as hard a pivot as it sounds. I think the Super Bowl is going to tell us that story.
Go on. I was waiting for Anna to talk about PepsiCo, but here we are.
I think you can plug Pepsi into the story for what is happening with the Super Bowl, but people are out there to party right now. And the Super Bowl is just going to be a massive example of that. It's going to bring everything together. You've got Vegas, you've got gambling, which the NFL is now on board with. You've got Taylor Swift.
How much FOMO do you have right now? Just out of curiosity.
So this is not my weekend of sport looks very, very different. I'm not going to be staying up. I'm going to be watching England beat Wales at rugby, which is going to be fascinating. I'm hoping the Scots beat the French. I think Liverpool are going. I wouldn't want to be Burnley this weekend. In terms of Arsenal beat Liverpool recently, I think Liverpool are going to come back. But I think in terms of, I'm not interested in the sport. I don't really care about the sport, but what I do care about is just what this represents. It just shows the US economy booming.
It does, and I'm going to join another dot between these conversations that we're having here. Lionel Laurent, one of our opinion columnists, writing about gambling side of sport and how that's really taken off in the United States. And that's going to be something that we'll see this weekend. But one of the features of that has been London-listed businesses chasing that new opportunity over in the United States. And that means sometimes delisting from here and going over there to chase that growth in that much bigger market. Talking about Taylor Swift, apparently you can bet on all sorts now to do with this game. Will she cry? Lionel says is one of the things that you can bet on. I'd like to see the science behind how they work that one out.
I'm sorry. Will she cry like tears of joy? Is that what we're talking about? Or
I don't know if it's specific.
The Kansas City Chiefs are on good form at the moment. I understand that the Kansas City Chiefs aren't even in Kansas. So that, again, is just confusing.
My mind. What is the connection between the Kansas City Chiefs and Taylor Swift?
So her boyfriend plays tight end.
Oh, okay.
Come on, Chrissy, we're relying on you for the sport
I wanted to test Guy's knowledge. I wanted to see just how plugged in he was into the gossip.
And so Patrick Mahomes as well, amazing. So he's basically, have they been in 4 of the last 5 Super Bowls?
I don't know who you're asking right now. I know more about soccer than I know about this, which is I think counter to what I should be. But I think what's crucial about, to your point on the gambling story, is we're talking about disposable income. These tickets are not cheap. Vegas is not cheap.
Hotel rooms are not cheap in Vegas.
It's a live shot of the stadium. That stadium is really small, apparently, which is something that I wouldn't have thought would have happened in Vegas. But apparently it's a small stadium, cozy. So as a result of which, fewer seats, and as a result of which those seats go for higher amounts.
So on top of that, if you then see a lot of gambling revenue, casino revenue, et cetera, it's not just talking about party and having a good time. There's excess disposable income here. And that, again, comes right back to our macro. We just macroed the Super Bowl, guys.
We did. And then the advertisers will be after that, won't they? To your point about spending. So
I hear the Beckhams are in a commercial.
They are, but the trouble is, so I watched it. The Beckhams are in it, and there's a sort of Friends reunion thing going on in it, and now I cannot remember
I'm
what
a little
it was
offended they didn't ask us to be in a commercial.
Next year, we're going to be in that commercial.
Not
1 in 5 US adults apparently is going to bet on this game. That's a staggering number. Bets on this game.
The power of this business, the fast growth in this business has been quite staggering. Talking about the advertisers, though, we should probably say what's coming up in programming, because that actually links in with this conversation. Paramount CEO and president will be joining. This is the media giant that is hoping that the Super Bowl will have given its streaming business a boost. Some of our colleagues talking about how this is going to be an opportunity to really try and grow their subscriber base, of course, through this.
Patrick Stewart's in the advert, I think.
Through this extremely high-profile event. DHL Supply Chain CEO joins us also later on in programming. Is there no, this is connected with much more serious subjects, something also we've referred to a lot this week, which is around tensions in supply chains around the Red Sea.
Yeah, and we're talking a lot about what the read-through into is in Europe in particular, but Germany, you guys have been talking a lot about the weakness there. We had the UBS chief economist talking about the fact that this kind of blip will show up in PMIs, which is a read-through that I had not connected.
Strange positive. I was not aware of that.
It's a sort of negative, it's a weird way that it shows up. So if supply delivery numbers go up, it boosts the overall number, but actually is a negative. My biggest takeaway from today is these guys can go out on a Thursday night and deliver on a Friday morning. I am seriously impressed.
We will be crashing at 9:01.
Yeah, exactly. I'm definitely crashing from here. It doesn't happen every week, that's for sure.
I mean,
no.
I make no promises.
We're done now. Guy, you finish.
Okay, well, that wraps things up from Kriniana, from myself. Have a great weekend, everybody. Enjoy the Super Bowl. I'm going to be in Italy this weekend.
What a brag. Enjoy all the brag.
Yeah, so I'm going to be watching Ireland play Italy as well. That's going to be a fascinating game. Francine is coming up next. Looking forward to the Pulse, but have a great weekend, everybody. Thank you very much indeed for watching. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
And so he's on the bus
after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Joe Biden defends his mental fitness after a Justice Department report adds to concerns about the U.S. president's age. U.S. stocks hit another record with the S&P briefly topping 5,000 for the first time. The next catalyst for markets, CPI revisions later today. Plus, L'Oréal slumps after sales disappoint, hit by weak demand from Chinese travelers. But Hermès surges as it weathers the luxury slowdown. So first thing is first, let's take a look at the European markets map. We actually had quite an interesting week for the markets. If you look at European stocks and bonds, for the moment, small moves. Investors really remaining pretty cautious ahead of U.S. inflation data due out later today. Now, if you look at what bond markets have been doing, certainly traders there have spent the week trying to juggle, I guess, a string of well-received U.S. bond sales against this cautious language on rate cuts from central bank policymakers. Now, we did have annual revisions to monthly U.S. inflation data, and that's attracting quite a lot of attention after last year's adjustments are now casting doubt on the Fed's progress in taming inflation. Consumer prices. Now, President Joe Biden's age and ability is back in the spotlight ahead of the U.S. election. It follows a Department of Justice report into his handling of classified documents, which describes President Biden as an elderly man with a poor memory. The report was led by a former U.S. attorney appointed by Donald Trump, was likely to be Biden's opponent in the race for the White House. Now, in a hastily arranged press conference on Thursday night, President Biden forcefully defended his memory before mistakenly referring to the Egyptian president as the leader of Mexico.
As you know, initially, the president of Mexico, Sisi, did not want to open up the gate to allow humanitarian material to get in. I talked to him. I convinced him to open the gate.
Well, joining us now to discuss all of this is Bloomberg's Ross Matheson. Ross, as always, thank you so much for joining us. This is pretty extraordinary.
Well, that's right. I mean, this is a very consequential election year for the US, and possibly this week, looking back, will have been one of the most consequential for Joe Biden. He's likely to face Donald Trump in the election. You know, Donald Trump is on a march. He's got momentum in what we've seen so far, despite all the court cases against him. And even though they're very close in age, they're both relatively elderly men. It's Joe Biden who keeps getting the attention and the questions over his mental capacity to do another term as president. You saw that very sort of heartfelt response from Joe Biden yesterday. The attacks, could he remember the date that his son died of cancer, for example, and in that report. But at the same time, as he was leaving that press conference, almost out the door, again confused two leaders. He's done that in quick succession. He mixed up the former leaders of Germany recently, of France. You know, he's got a lot going on. He's running the US economy. He's got, you know, the US is sort of semi-involved in wars, both in Ukraine and the Middle East. A lot of challenges, but the US president has to be up to those challenges. And so essentially it's just red meat for the Republicans at this point.
So what else did we see in the report? I mean, as you say, it just got very, very personal.
It did. It was sort of saying he's an elderly man who has mental challenges. And this was more about whether he, you know, knowingly took classified documents and kept classified information. And in a way, that conversation has been overtaken by these comments about his capacity mentally in the report. He's an elderly man who has trouble remembering dates, remembering people, remembering events. And it's less about whether he knowingly did something wrong, but his capacity as president and the very personal nature of the comments about whether he could remember the date his son died. And that's really what fired Biden up in that press conference.
Ross, how bad is this actually, you know, in terms of polling, in terms of what the American people will do in the election? Is there now a war room where Democrats are kind of scratching their heads saying, what do we do next? Is he actually going to be the Democratic nominee?
Well, there have been lots of those conversations behind the scenes. We know that they're going on and possibly escalating, but we're at the point where it's probably too late to do anything because it's really up to Joe Biden if he wants to run again. It's his choice, his decision, and what he said, and we know going into the previous election, he saw himself as the only person who could beat Donald Trump in the first election. He said that very clearly. He felt he was the only one who could do it. And given it's going to be Donald Trump more than likely again, no doubt he sees himself as the only Democrat again who could do a repeat. So very much he sees his task here as something that he fundamentally he needs to do. But they can't make him step aside. It's really up to Joe Biden, and he seems determined to continue.
I mean, did the report come as a surprise? Because the press conference seemed to be arranged quite hastily.
It seems that the sort of the comments again about his age and his mental capacity came as a surprise. I mean, there's nothing in that report that suggests that Joe Biden is going to be charged with anything. And again, the focus was supposed to be on these documents and the classified information, but that really seems to have taken them by surprise. Hence the response last night.
Yeah, such a big story, Ross. Thank you so much for joining us. Our Bloomberg EMEA News Director, Ross Matheson. Now, we're also joined by Eric Nielsen, Group Chief Economist Advisor at UniCredit. And Eric's thinking, I'm so glad I'm not in politics right now because I wouldn't probably know what to do with this. But, I mean, this could actually change, I guess, the face of an election. And so this could change the economy and certainly what happens to the rest of the world.
Yes. I mean, it's as Ross said, it's hugely consequential, right? I mean, it's two different visions of America and two different visions of America in the world. So it's very easy to, as far as I can see, among investors and clients of ours and ourselves, it's very easy to be caught up in the dislike of Trump and all the things that he says and the behaviors and all the rest of it. But when you think about what policies might follow from a second Trump presidency, it doesn't look good for Europe for sure, right? Most people I speak to think that because of the Heritage report, that you could see some very big tariffs, for example, a big fiscal boost via tax cuts to the corporates. That could boost America short term, not long term, right? But for Europe particularly, and for Asia, the rest of the world really, this is a very scary outlook.
If you look, Eric, and you have been such a champion, actually, of, I guess, European values and integration, right? I think it's fair to say that. If you're Europe right now and we have European elections, you know, are they rethinking in Brussels the leadership of Europe to somehow counter that?
If you speak to them, I was just in Luxembourg earlier this week and saw a number of policymakers who had gathered there for a big event. The answer is yes. There's a lot of talk about the need for more military or defense spending. There's a lot of understanding of the climate change, the demographic challenges in Europe. But I sense no strategic top-down appreciation for what it takes. So this is my big concern. One thing I would say that I came away with a little bit relieved was, for the first time, there was a clear, at the top level, there was a clear appreciation now, understanding and knowledge that Europe has vastly underperformed America for almost 2 years now. Vastly. Like one of the biggest divergence for decades. And the question has started then to emerge. Why? I don't think they got the answer.
And why? I mean, is it also, I mean, Germany's also, frankly, not doing great.
Right. No, right? Sure. So there's that aspect. Within Europe, the tables have turned, right? Now Italy and Spain are looking pretty good, Germany looking poor, right? So they shifted. But why? I mean, I think there are two clear differences. Europe was hit by a much harder shock than America, gas prices and all the rest of it, much harder than America. And then America got the big fiscal stimulus. Those are the two key reasons. Monetary policy has done the same, and everything else have not really moved. The curious thing is that is not really appreciated as far as I can judge. The good news maybe is that you hear now I heard a lot of policymakers talk about it's red tape, too much restrictions in Europe, and that's true, but that didn't change the last 2 years, right? No. But if we can get our top leaders to appreciate that Europe is regulated and too much red tape, then that's certainly a good thing, right?
But I mean, and this is also reflected, as you say, in the economy. I mean, valuations for stocks and everything. Does it make the ECB's job harder than the Fed and Bank of England?
Yes, for sure, right? I mean, the heterogeneity in Europe makes it very complicated for the ECB. But as you know, I don't think that's the key issue at the ECB right now. The key issue for the ECB is that they see shadows on the walls, right? I mean, we saw Isabel Schnabel's interview earlier in the week, and it's inflation has come down. It's not all the way down yet, but where America has a beautiful story, and they say, well, maybe it is so good, maybe we wait a little bit. In the ECB, we wait a little because we could see maybe a little tick up, like. So I think my problem with the ECB is that they have tightened too much, and but it's certainly a difficult job for sure.
So let's go back to the Fed. Yeah. And first, we also Tom Barkin was speaking yesterday from the Richmond Fed. Here he is.
Gratified to see inflation coming down, hoping it continues to come down, and I think we've got some time to be patient. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
See, Eric, I find it tricky because so the markets think that there's going to be cuts. I mean, they've kind of readjusted, but it was still cuts, and they've already priced it in. Then you had a lot of Fed presidents saying, look, I don't know if they were scared of that U.S. jobs number or just in general, they don't really know what the picture for inflation looks like in the second half of the year. Yeah.
No, I think that's in America, it's harder because there was a fairly big chunk of demand that pushed inflation up, but it has still come down really beautifully. Yeah. But I think, I mean, you see these statements we've had the last week or two. I mean, these guys are looking at each other and say, they cannot believe the luck they have. All the debate about can we do a soft landing and all this stuff, that discussion is gone. They are looking at a beautiful picture. So of course they can take it easy. Of course they can. Why try to risk anything right now?
But so, Eric, so they're taking it easy because they have an easier life, or they're taking it easy because actually, the last mile, taking inflation down to 2% is the hardest.
Yeah, I don't buy that. I don't know why that necessarily. So Philip Lane had a fantastic talk in, was it yesterday, the day before yesterday in America, where he actually also analytically disputed this. But leave that aside. You're right, America, the Fed has an easier task. The American economy is a car that's a lot easier to drive than the European car for the reasons you mentioned.
Yeah, but it's firing on all cylinders, which is quite extraordinary, right, given how much they've tightened.
Yeah. Fiscal policy, right? They're running 7% deficit, double of Europe, and they've got the IRA and all the rest of it. It's like when you're pumping that type of money in, it is amazing, right? What it does.
When do we worry about debt? I know, a bit of the auctions. Like I know traders were like holding on to their desks, saying, "Oh, it's a 30-year." At some point, will this backfire?
Yes, of course. I mean, debt has to be sustainable, and I think it is. But that question is relevant. But it's America, right? It's the world's reserve currency. I've heard for the last week or two, for the first time, people with regard to Trump, these questions, if he does a big tax cut, could we have a Liz Truss moment in America? I don't think that's particularly likely. because the U.S. Treasury market is so big and it's the global reserve currency. So I don't think that's at all likely. It's not zero probability, right? But
So this is like U.S. exceptionalism continuing.
It is U.S. exceptionalism. I mean, it's the underlying story that the U.S. is an amazingly flexible economy. We knew this, right? So when you shock an economy that's flexible, it bounces better and faster than one that's not. We knew this, right? So that's at play. And then on top of that, we got Joe Biden's, attempt at industrial policies or whatever. Long term, we can have this discussion, but we had this discussion over 10 years ago when we had austerity here and the Americans did, and those who were in favor of austerity in Europe, which gave us 3-4 years of underperformance also, not as bad as now, underperformance. The discussion was, but it's not going to last. It's short-term pain for long-term gain. But the long-term gain never came, right? Yeah. So we have a real problem in Europe. And I think the problem is that on the fiscal policy, fundamentally, we have this pride. Now we got the fiscal rules more or less sorted out. That's a bottom-up discussion of accounting issues. Yeah, exactly. And there is no discussion. Everybody agrees that defense spending may need to be 1 percentage points higher, 2% maybe, whatever it is, but is a lot higher. Yeah. Everybody we need more for climate change. Everybody we need more for education. We need for this, but nobody cost it and then bring it down from top down.
Yeah, so that's structural. Eric, thank you. We'll come back and we'll talk about that and also China. Staying with us for markets and the economy, Eric Nielsen, Group Chief Economics Advisor at UniCredit. So we'll talk China next, and this is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world, and I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, another wild week for Chinese stocks, and that's left investors yearning for more policy support. Meanwhile, there are concerns still that China's property slump could spread globally. Well, still with me, Eric Nielsen, Group Chief Economics Advisor at UniCredit. I'm still going to call you economist because I can't quite get
I'm an economist. Just call me an economist.
Eric, China, so we're in the Lunar New Year, and so there's going to, they're going to be off for a couple of days. Yeah. But China's like still a mystery, actually, and certainly in terms of what the PBOC and what policymakers can do to try and stem and kind of stabilize not only markets but the economy. Yeah, they have the problem is huge in China in that sense. I mean, you have the structural decline because of demographics, right? This we know.
although they don't seem to appreciate it when you look at their growth expectations, forecast, or targets, or whatever you call them. Then you have this big, as you just mentioned, this big issue of the real estate side and deflation across the economy now. So I mean, just as an order of magnitude, right? The debt they have in the real estate market and the banking that's related, or the financial sector that's related with it, last time I saw 2-3 times higher than it was in pro rata terms to Spain and Ireland before the crisis. We've never seen these leverage levels not ending in a crisis, ever, right? Can China walk on water? Maybe, but I wouldn't bet my money on it, right? So there is a long adjustment. The good news is that the Chinese government has money and power, right? But do we believe that they are better than the market economy to adjust it? I don't think so. So coming specific.
But we used to think that.
Yeah, because when you have had 20 years of 10% growth, you think they can walk on water, right? This is the issue, right? But reality is setting in. And coming to your point, this is exactly the problem. So now, how do you stimulate? So what they do, as far as I can judge, is they start to pump money in, but they pump money in to the politically related companies, which are the big old industries, instead of the dynamic part of the economy. And that doesn't look good for the longer term. So
Eric, do you worry about commercial real estate in general? So it also, there are a couple of bank troubles in the U.S. in the last week, and that seems to be spreading. I don't know whether you're worried about a financial stability or a credit event.
Credit event. I mean, look, we have had the biggest monetary policy shock in my living memory, right? It's in the OECD area. To think we get through this with no sort of financial sector issue is hopeful, right? And I think the good news is that Europe didn't have any issue apart from in Switzerland, right? And so that gives a lot of credit to those who designed and implemented the adjustments after the financial crisis. So European banks, as far as I can judge, are in very fine shape. And the big American banks are. But then we have all the gray stuff outside. I don't think it's reasonable to think that, I mean, we can always look at everything is possible, but it's not reasonable to think that that's systemic, right? Yeah. But credit events, I would be shocked if we don't get more.
Eric, so interesting. Thank you so much for joining us. That was Eric Nielsen, Group Chief Economics Advisor at UniCredit. I got it right this time. Coming up.
I'll chase it next time.
Yeah, after L'Oréal's quarterly revenue fell short of estimates, it seems slow Chinese demand continues to be a problem. Immerse, though, reports strong sales and growth. We look at what the Bergen bag maker is doing different. We talk luxury next, and this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Hermès has reported strong quarterly sales growth as shares in the French fashion giant hit an all-time high this morning. Now, meanwhile, L'Oréal is struggling. That's after the cosmetic company reported sales that missed estimates due to cooling travel spending in China. Now, we're joined by Bloomberg opinion columnist Andrea Felsted. I love every column that Andrea writes, who's always interesting and always a little bit of a twist, so I urge everyone to go and read it. Andrea, I mean, Hermès, if you speak to any luxury CEO, they want to be Hermès, and the numbers once again prove it. Like, how are they getting it so right?
What they've achieved something that's very difficult to do. They've got the two iconic handbags, the Birkin and the Kelly, which everybody wants. There's a waiting list. They're hugely expensive, trade for a lot more on the secondary market. But not everyone can get one or afford one. So what they've done is they've actually developed some other really nice handbags, which are quite popular, becoming more popular with the quiet luxury movement. So if you can't get a Birkin or a Kelly, you buy another bag. And what that hasn't done is detract from the popularity of those icons. They also introduced beauty, another way to access the brand without diluting it. They've managed to do all this, and everyone still wants the bags.
Speaking of cosmetics, I mean, L'Oréal is struggling because of the Chinese traveling market.
That's right. I mean, across the sector, China hasn't come back as much as everyone was expecting. There's a big push to get people spending at home in Hainan, but the Chinese have started to travel a bit locally. What they're not doing is traveling to Europe again.
So I know we're talking about luxury and cosmetics, and we have little time, but is there a secret sauce to getting it right? Like pricing pressures, can big luxury companies really afford to hike up prices 30% without hurting demand?
It's all about desirability. On every call, every luxury conference call, we want to increase the desirability of our products. And if you've got that desirability, you can charge a higher price. You can make things more exclusive.
Andrea, as always, thank you so much. Andrea Felsted, they're our opinion columnist focused on luxury. We'll have plenty more throughout the day. We look at U.S. inflation, we look at markets, and of course, we continue looking at luxury. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
Joe Biden defends his mental fitness after a Justice Department report adds to concerns about the U.S. president's age. U.S. stocks hit another record with the S&P briefly topping 5,000 for the first time. The next catalyst for markets, CPI revisions later today. Plus, L'Oréal slumps after sales disappoint, hit by weak demand from Chinese travelers. But Hermes surges as it weathers the luxury slowdown. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Well, Vladimir Putin says Russia has not achieved its objective in Ukraine as the war nears its 2-year mark. Now, speaking to Tucker Carlson Network, the Russian president said he would consider negotiations only if the U.S. stops supplying weapons to Kyiv. The Russian leader, who's overseen the jailing of several American journalists, was giving his first interview to Western media since the invasion of Ukraine.
What we are conveying to the U.S. leadership, if you really want to stop fighting, you need to stop supplying weapons. It will be over within a few weeks. That's it. And then we can agree on some terms.
Meanwhile, South Africa's President Cyril Ramaphosa has given his State of the Nation address as the country prepares for the tightest elections since the end of apartheid.
We have laid a foundation for growth through far-reaching economic reforms that we have embarked upon, an ambitious investment drive, and an infrastructure program that is starting to yield results.
Now, for more on this, we're joined by Bloomberg's Jennifer Zabazaja. Jen, always good to have you on with us. So what's the reaction to the State of the Nation address been?
Yeah, Fran, good to be on the show. You know, the reaction's been relatively muted and a bit disappointing, especially if you take a look at some of the newspapers. This one has a hollow speech devoid of truth, and then we also have the Mail and Guardian, which says Cyril spooks and stagnation. And I'm just showing that just to illustrate really what the reaction has been. Last night we saw this speech about 2 hours long, with the president largely defending the 30 years of ANC rule, which is the African National Congress, and, you know, not really walking us through a lot of policy changes or things that he's planning on doing to sort of turn the country back to where he says it should be and it can be. He did walk the nation, though, through what he believes are the successes of the ANC, which includes broadening access to education and health care. He also talked about a new climate change response fund and a pledge to overhaul the nation's healthcare system. But, you know, outside of that, you know, he talked a bit about the struggles that the country has gone through, but also alluded to the fact that a number of countries go through struggles and that under the ANC, they have been better off. Black South Africans have been better off, and the country more largely has been better off. But, you know, if you take a look at the electorate and the things that the electorate has had to go through over the past few years, it's kind of a tough sell.
And Ramaphosa's office, Jen, has also said that he will announce a date for elections this year by the end of February. Yeah. So how's that shaping up?
Yeah, and many people were expecting him to potentially make that announcement last night. He did not, but he does have a bit more time to make that announcement. Look, the plan, the real meat of this is that this was the last State of the Nation before the election happens. And so many analysts were going into this assuming that the president would talk more about the, the economy, which many people are struggling with. Nearly 32% unemployment. We've had electricity shortages. There's also been logistical challenges, which have set the economy back largely. And so the expectation was that he was going to go into it, but did not go into it. And it's not just that. There's also a lot of people who are expecting the ANC potentially to lose their majority in this election, which would be significant for the economy and significant considering the 30 years that they have been in the majority. And so, we didn't hear the president focus too much on that, but instead just trying to really convince people that the ANC is the one to lead this economy. And not really helping the situation, Fran, is the fact that we've seen a weakening rand. We've also seen commodity prices drop. And so a lot of economists are waiting to get a little bit of direction. So now we're pivoting to the budget speech, which is coming later this month from the finance minister. Perhaps we'll get some indications of where this economy is headed.
Jen, thanks so much. As always, Jennifer Zabazaja there with the very latest, of course, on South Africa. Now, shares and dollar bonds have fallen in Pakistan today as the country's vote count faces lengthy delays. The widely expected outcome of a return to power for three-time Premier Nawaz Sharif is looking lesser. The party of jailed former Prime Minister Imran Khan, whose candidates have been forced to run as independents, is claiming a shock victory. But Sharif's supporters are also claiming a win, raising the prospect of instability in the country. So let's take a look at some of the corporate news as well. ExxonMobil plans to leave Equatorial Guinea within months, ending almost 3 decades of oil drilling that made the country an OPEC member. The small West African nation became one of the world's hottest oil provinces around the turn of the century. But output has since dried up along with foreign investment. Now, Bloomberg has learned that Saudi Arabia is set to hire banks, including Citi, Goldman, and HSBC, for a secondary share sale in Aramco. The world's biggest oil exporter is also said to be in talks with other banks as it pulls together the offer that may come in the next few weeks. Now, the follow-on offering would raise about $20 billion, making it among the biggest in recent years. Bloomberg also understands that the electric car battery venture steered by Stellantis and Mercedes is close to raising 4.4 billion euros in debt to finance its European expansion. Now, Automotive Cells Company is also in talks with several banks and could announce a debt deal soon. Battery plants are key for Europe's efforts to step up a local supply chain to rival Asia. Coming up, the UK Chancellor of the Exchequer says there is an attractive option to rejuvenate the UK stock market. We'll have more on our fireside chat with Jeremy Hunt. That's coming up shortly, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is a Pulse. I'm Francie Lacqua here in London. Now, shares in chip designer ARM soared in New York after the company boosted its forecast in a blockbuster earnings report. In an interview with Bloomberg Technology, the chief executive, René Haas, says ARM is poised to be a key beneficiary of the AI boom.
This is really the results of strategies that were put in place a number of years ago that are now just really starting to come to fruition.
Yeah. When we think about the vindication, when we think, though, still about basically more of your technology going into more types of equipment, you've managed to see a diversification out of phones. Paint us the strategy of ARM going forwards, because many would say, actually, you're not just, well, the overall designer of chips, you're basically making the chips. You're fabless in some way. How do you see that relationship going forward with Qualcomm, for example?
Well, a lot of folks, as you said, didn't really understand the company well and where we fit. And obviously, we had a lot of growth attached to the smartphone market. But ARM is in a lot of devices that people may not naturally think about. We're in a Tesla vehicle. We're in a Ford F-150. We're in a Ring smart camera. We're in a Samsung TV, a Samsung smart appliance. So just about every device you can think of has ARM inside. And just about every device you can think of needs more and more compute, particularly as AI is now driving a whole new demand cycle.
Talk to us about AI. Jeffrey is really singling that out, the analyst there, saying that this really shows you're a beneficiary from AI. But where does the AI focus come? You, of course, were at NVIDIA before. They are all about AI accelerators. And I'm interested as to whether or not that would be an area that you get into other than servers.
Well, right now, NVIDIA is a great partner. Their Grace Hopper chip, a super chip, uses a lot of ARM CPUs in combination with their GPU, which is a really, really great solution for high-end AI training in the data center, as well as inference. But when you start moving to smaller devices, say smartphones or PCs, well, AI is going to run there too. If you look at some of the recent announcements by Samsung and Google relative to their smartphones, there's a lot of things such as circling an image on a browser and then having that browser go off and do search based on the circle. That's AI. That's actually running in a smartphone. And what we're seeing is really a drive for more and more compute capacity to run these AI algorithms, some that people don't even know what they are yet. But what designers want to do and need to do is future-proof their designs with more and more compute. And that is really driving a strong licensing cycle for us in terms of more demand.
Well, that was the ARM chief executive, René Haas, speaking to Bloomberg Technology. Now, the UK Chancellor of the Exchequer, Jeremy Hunt, told me in a fireside chat that he's very attracted to the idea of creating a tax-free savings account for investing in British stocks. Now, it would form part of his Conservative Party's efforts to boost the UK's struggling stock market ahead of the next general election. Well, let's discuss all of this with the UK government reporter, Joe Mace, who's been following this very, very closely. So, Joe, good morning. The Chancellor, of course, facing calls to create this tax incentive for British investors. Is it any closer to reality? And does the city actually think it will have a big impact?
Well, last night he seemed to suggest that it is something the Treasury is strongly considering. We thought he might do it at the autumn statement in November. He didn't, which just disappointed some in the city, but it looks like still very much on the table. I mean, one key question is there the money to do it? That's always the question with Chancellor budgets. He was saying to you last night, I haven't got the final numbers from the OBR. I don't know how much money I'll have to play with. And he's clearly got a big shopping list of things he'd like to do, such as cutting income tax or cutting national insurance further. So the British ISA will kind of be part of that mix. It might be prioritized. We'll have to see how that goes. Would it make an impact? Well, some in the city clearly feel it would. You know, the demand side in the UK stock market has clearly been a point of weakness. And if you could boost that, then that could have that knock-on positive effect. But, you know, there are big structural issues facing UK equities. Maybe this wouldn't be, you know, a massive game changer. But I think it would help. And certainly that's why asset managers have been calling for it.
But again, Joe, I guess the problem is that is this just going to be a budget for, people to vote Tory at the next election? I mean, it changes everything because there has to be an election in the next 12 months, and they're really far behind in polls.
Yes, I think you're right. And therefore, that would suggest that Jeremy Hunt would prioritize any kind of fiscal measures, whether that be tax cuts, which have the biggest impact in terms of electoral gain for the Conservative Party. And that would suggest perhaps doing more things like an income tax cut or reducing national insurance further, rather than something more specific in the world of finance, as a British ISA might be. He might prove you wrong, but I think that, as you say, the electoral pressure is strong and the money is tight. So this is a tricky one.
So let's also turn to the big politics story of the week, which is Labour and Keir Starmer, and his green rollback. How damaging is it for the opposition Labour Party?
It's a hard one to say, in that, on one hand, clearly it doesn't help Labour's reputation for being kind of consistent, always sticking to its word. On the other hand, I think Keir Starmer would argue that it's taking a kind of target off their back, which the Conservative Party was kind of relentlessly hitting, saying that you cannot be trusted with the nation's finances, you're going to borrow £28 billion. I think he'd be quite happy to kind of shrug that off and say, look, that attack doesn't really apply anymore because we have this new, much more scaled back plan, only £4.7 billion yet. A big reduction from that 28, and he can flip the argument and say, look, we are being very honest with you as the electorate. Look, we cannot do this. The public finances have deteriorated since we made that pledge. They blame the Conservative Party and kind of the Liz Truss era particularly, and therefore, try and turn into a positive for them and say, look, you can now trust us, and we're going to be safe with public finances. So you can argue it both ways.
But Joe, and you and Phil Aldrich have done some, great work mathematically on actually how much, again, fiscal room there's space. I mean, whoever's in power will just struggle to find the money. So the money has to come from somewhere, right?
Yes, exactly. And I mean, I was in the briefing yesterday with Keir Starmer, and he was saying to the press, look, the Treasury and Jeremy Hunt are likely to really push the envelope at the next budget for the reasons we just talked about, because of that electoral pressure. So to the point where tax cuts will happen and public spending might get cut, for example, so that any inheritance Labour would have if they do win the election would be very tight, and to the point where they might have to reverse tax cuts and try and increase public spending. Where is this money going to come from? You're exactly right to ask that question, and that's why it's just it could be so difficult for them to do any of their plans, and that's why we saw this massive reduction on the green spending pledge.
Yeah, Joe, as always, thank you so much. Great, of course, work there from you and the team. Joe Mays from our UK government team. Now, veteran emerging markets investor Mark Mobius says Hong Kong and China shares are becoming attractive due to return ratios, earnings, and debt. Mobius was speaking in an interview with Bloomberg.
And I think they're going to see some good opportunities now, because the Hong Kong market, as you can see, has been driven down to very, very low levels. Of course, it could go lower, but we're now beginning to see people make comparisons with India and China and Hong Kong, of course, and beginning to think, hey, maybe India has gone too far up and there's an opportunity for Hong Kong, China side stocks to perform. I'm not predicting that, but I think people are beginning to look at the valuations. I'm beginning to think that perhaps there's going to be a good opportunity there. The Chinese officials are trying their best to regain confidence, get people to be confident again. But you must remember, at the end of the day, it's the Chinese investors who drive the Chinese market, not foreign investors. So the first order of business will be for them to instill confidence in the Chinese investors' minds. But I think that will eventually come once this housing problem is over. It'll take some time, but as you know, most Chinese investors have a lot of money in their property, more than in stocks.
Well, that was Mark Mobius, Chief Executive and founder of Mobius AI Investments, speaking to Bloomberg. Coming up, Las Vegas is getting ready to host America's most watched sporting spectacle. That's, of course, the Super Bowl. Now, billion-dollar businesses, a new class of investors circling for football teams' ownership. We discuss that next, and this is Bloomberg.
there is no digital without chips. And I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
So Walt Disney's ESPN, Fox, and Warner Brothers are joining forces to launch a sports-focused streaming service. It will feature major college and pro games usually seen only on traditional TV. Earlier, the chief financial officer, Hugh Johnston, joined Bloomberg to talk about the company's new joint venture.
The focus when you do a three-way JV is on how do we make sure that we get the operating principles right so that the parties are aligned up front and they're aligned ongoing in delivering a great product to consumers. And that's the real focus here is how do we make it easier and reduce friction for the sports fans? So we're going to get to pricing shortly. We'll get to a name at some point, I'm sure. But what's most important is I think we're going to deliver a product that's going to make your life a whole lot better if you're a sports consumer.
Hugh, do you think that ultimately the idea of a bundle going back to the future and getting people with reduced friction to find their sports team and find the game that they want to watch is going to take eyeballs away from some of the other providers, the cable networks, that have traditionally had these contracts? You're going to bid directly on some of these sports rights.
Well, I think it's going to be targeted more at people who either were never in the cable bundle or people who had already departed from the cable bundle. You know, at the margins, might there be a little bit of shifting? Yeah, there could be. But to tell you the truth, I don't think sports is going to be the reason that someone makes that shift all by itself. I think there are a lot of factors that weigh into that. From our perspective, we're focused on meeting the fan wherever they choose to be. I don't think we're motivating the fan to move. But if the fan does move, we want to be there because we want ESPN to be everywhere.
Hugh, we're super interested in how you're going to bid for those sporting rights. Do you think you might bid for them as a joint venture? How's this going to work in the months and years to come?
No, quite the opposite. We all will be bidding independently, and that's something that we're quite firm on, as that is not the purpose of the venture. The purpose of the venture is purely distribution. It's not about procurement of content. So we'll continue to compete with each other for sports rights, just as we always have. It'll actually, I think, be a great benefit to the league because it's no different in terms of the way we bid for sports rights, but that reduced friction benefits all of the leagues as well. So I think the leagues will actually be pretty optimistic about this.
Well, that was Hugh Johnston, the Disney chief financial officer. Now, it's Super Bowl weekend. Everyone's so excited in the newsroom. Today's Big Take looks at a different side of America's biggest sporting event. Once treated as heirlooms, while pro football franchises are now billion-dollar businesses, and a new class of investors is circling. Let's go to Bloomberg's Charlie Wells, who joins us now. I mean, we're kind of obsessed with the Super Bowl. As Europeans, you kind of think it's really a show, and so it's about the ushers playing, and it's a real show what Americans do best. But if you look at the National Football League, there's also investors wanting to go in. What do we know about the next wave of succession?
Yeah, well, Francine, as you say, it's a show, but it's also a show business, and it is a billion-dollar business. I mean, the NFL's revenue last year was $20 billion. And look, I'm not a quarterback, but I do love a good story, and today's Big Take is really good, and it focuses on this kind of family succession problem that we're seeing in the NFL. And something that's really unique about the NFL is it has been very family-oriented, very family ownership-oriented, especially compared to a lot of sports. I mean, until the 1980s, a single individual had to own 51% of a team. So we're slowly seeing some of that change. We're seeing some of the tax implications of trying to pass on these teams through generations, and we're seeing some people potentially want to sell to private equity, and private equity being very open to that.
So private equity, are they doing because it's jewels and it's fun and it's famous, or is it actually because they want to make money out of it? Can they make money out of it?
I would say there's a little bit of both. I mean, we've seen huge appreciation in these teams. I mean, you know, from 2020 to 2023, some of these franchises on average, they appreciated 70%. The average team in the NFL is worth $5 billion. And if you're thinking about this from kind of a private equity perspective, you know, you see a business where there's been kind of mom and pop owners, right? But that are incredibly lucrative. Maybe there's some management issues and then potential rule changes. And so this looks like a prime opportunity. But as you say, it's also really fun. It's kind of cool to say that you have some ownership in an NFL team.
It is. It's like a jewel in the crown, right? I mean, it's like the thing that it's good at a party, basically, to put that into conversation. What does an NFL owned by private equity look like?
Well, it probably looks like a lot of different kind of sports teams. You know, in the U.S., you do have, you know, more private investors in baseball, in hockey. We know that in European football and soccer, you do see a lot of this. You see, you know, player salaries in other sports teams just like escalating, whereas in football, those salaries are actually fairly well controlled. So you could see some serious changes. A lot of these families, you know, some of them do want to offload to private equity, but some of them want to retain that control. And there is this element of being a part of the community. You get kind of local celebrities buying in at sometimes. You get former, you know, stars from some of these teams owning parts of these businesses, and so that could change.
So you're watching the Super Bowl. Even I'm kind of tempted. Yeah. More for the party with friends aspect.
It's an extravaganza.
It is, and Ushers. I mean, do we know who else is singing?
It's all about Usher, right? You know, you can't compete.
Agree. Charlie Wells, always spot on. Thank you so much also for bringing the business side of what is going to be a fun Super Bowl. You can read today's big take on the NFL's Succession Challenge on your Bloomberg terminal. Up next, a Bloomberg Brief. Danny Berger, Manus Craney in New York, and this is Bloomberg.
Ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970, Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
U.S. stocks hit another record with the S&P briefly topping 5,000. Investors now await the U.S. CPI revisions data today.
L'Oreal slumps after sales disappoint, but Hermes surges as it weathers the luxury slowdown.
And hedge funds must share more about their investments, borrowing, and counterparty exposure under the new SEC CFTC rules. Death, taxation, and regulation.
I thought you were going to say an Hermes.
The Hermes is on the way. She's always on the play for a bit of luxury. But I'll tell you what, the luxury of the bond market. It's interesting. We're up 15 basis points on the week when it comes to 10-year government bonds. The 30-year bond auction went pretty well yesterday, to say the very least. Yields tick higher. We wait for the CPI revisions. The bid to cover ratio on the 30-year government bond auction was 2.4 times. Bang on the average. Now, the question you need to ask yourself is whether that sort of drift higher in the steepeners, the 5s, 30s, runs out of puff. I literally just ran the chart for the week on 10 years. It's interesting. You just see those incremental rises in yields. We're a bit skittish and nervous because it was squeaky time at the end of last year when the CPI revisions. The dollar is flat at the moment. You are just seeing, again, underweight positioning going into these CPI numbers. Bank of America say the hedge funds have actually bid up the dollar, forcing a rethink by the buzz. Brent is up by 1/8 of 1%. We put on 6% this week. Again, 3% ramp higher yesterday. Netanyahu dismisses any talk of any possible settlement or ceasefire. Danny, good morning.
Good morning, man. We're just treading water in this equity market. Will we hit 5K and stay there? We certainly hit it yesterday, but we didn't stay there. The futures market, yes, it's been trading at 5K, but will the CPI revision either get us there or pull us back? Even Waller was talking about it. Everyone's talking about it. So why not care about it if you're an equity investor? So we're barely changed in the S&P. NASDAQ outperforms this morning. Tech's good day was probably all due to ARM yesterday, adding some $38 billion in market cap, a 48% surge off of good earnings. But when it comes to earnings, yes, we are a little changed in European equities. Underneath the surface, Manus, you mentioned this, it's L'Oreal doing poorly, the Chinese shopper not going on holiday, not buying those L'Oreal goods in airports and abroad, while Hermes, I mean, they've cracked the code of scarcity, Manus. And I know it's all about positioning, and we're going to talk about your cash positioning, whether it's good enough or not to buy me a Kelly bag. I think that's the real story here.
Listen, I'm in the market for $10,000 for you in a Kelly bag every day of the week. But it is cracking the code in terms of how to raise your prices. Have a look at this. This is the Flow Show. This is about money markets hitting a fresh record high, 6.02 trillion. You may say we're clutching at straws talking about a pop to 602, but this is all about the Fed pushing back. It's also about the New York Bank Corp. And I think what's even more interesting, Danny, is that when we talk about where is the money actually flowing, not just into the money market funds themselves, but also into prime funds. That's the higher risk assets such as commercial paper go pop.
Yeah, it is the interesting thing that we thought maybe money would come out of these money market funds and go into risk and go into stocks. It's going into risk, but it's staying in these cash-like short-term assets, going into corporate paper. At the same time, the Flow Show from Bank of America stocks had the biggest outflow in 5 months.
But you can sort of understand that as you trade up to this. I know we didn't make 5,000 last week, but you saw this velocity in the equity market, record after record after record. To what extent are institutions taking money off the table incrementally? Yes. We can redeploy from cash in due course over the year when those rate cuts come. It's the opportunity cost of staying in cash and not equity.
Well, Michael Hartnett says that huge ramp up in equities, it's going to flip to a headwind from a tailwind. That positioning is going to be a problem. Let's bring that to our guest. It's Emmanuel Cole, head of European equity strategy at Barclays. Emmanuel, great to see you this morning. Is positioning a problem? Are we overstretched in this equity market? And as Hartnett says, about to turn into a headwind for us.
Yeah, hi, good morning, Danny. Well, I think positioning is stretched in some part of the market. Call it tech, AI, growth stocks in general. That's where the money has been going. But I think this kind of tech exuberance is somewhat misleading because under the hood, you have a lot of parts or section of the market which are not over-invested, which have not seen much interest from investors, and that's very much what is related to the economy. So small caps, international equities, cyclicals, value stocks, these things have not seen much bid over the last 12, 18 months, despite a fairly strong rebound in zero-vol markets. So I think there are two narratives here. One is very much about tech and AI and this kind of new super cycle, which is really getting the inflows, and then the more kind of real economy type of exposure within the equity market, which is somewhat off the radar and not getting much interest from investors yet.
Of course, you have, as you say, Goldilocks anxiety. Can you just define what Goldilocks anxiety is? Does it mean you would recommend taking action to lighten up, or what exactly is? I love it, Goldilocks anxiety.
I feel like Goldilocks herself is pretty anxious. So
I've had enough of Goldilocks, to be honest with you.
Well, this is what I'm hearing when I see clients pretty much all day. I think there's a lot of angst, a lot of concern about Goldilocks, and even though the impression that the market is priced for perfection and things are going up every single day, in reality there is a lot of uncertainty about the macro environment, and a lot of investors we speak to are not convinced we're going to have a soft landing. They're not buying completely into this Goldilocks or best of both worlds type of market narrative. So again, if you look at some part of the equity market which are quite sensitive to economic expectation, they have not done that well, even on the year. I mean, you have small caps down 5% in the US, you have some of the US banks down quite significantly, you have commodities lagging as well. I will not even mention the Chinese market, which is really struggling. So there is a lot of concern within the equity market, which is maybe not reflected at the index level, because the headline indices are driven by tech. In reality, there is much more dislocation within the equity market.
Emmanuel, just hang tight for a second because we have some breaking lines to bring our audience. Manus, news out from Barclays. They are sparing no feelings. The lowest performers, no bonus for this quarter.
I mean, this is big news. This is all about the CEO. What we understand is there are a certain group of bankers out there that are going to get, what is it, zeroed out, goose-egged, or donut. We've got to make the other divisions of the bank as strong as the investment bank. So this is a radical response if this is what comes to pass on the bonuses. Barclays' brutal bonus cuts, handing out no bonus to some bankers. Not everybody.
Right.
It's got to be said, not everybody out there is going to get zero bonus.
Right. Juniors are still likely to be kept intact. The top performers might get as much as 10%. But the thing is, banks usually do this when they want to attrition out the lowest performers. That might be a problem for Barclays because the market's just starting to turn.
But also the two people there, Taylor Wright and Cathal Deasy, they spent last year trying to get people to stay at Barclays, handing out, as it were, guarantees, handing out to keep people, the star rainmakers, to stay with the bank. But of course, this is going to raise a lot of questions about what is the future of Barclays. It's the perennial question of Barclays.
Yes.
What is the investment bank? What role does it play in the institution?
Well, we're going to have an Investors Day soon, and we might find out. And I want to bring this to Emmanuel. Yeah. Emmanuel, I don't want to talk about your employer itself because I'm sure you can't answer those specific questions and what your bonus might look like. Of course, you're not an investment bank. But I want to ask you about European banks in general. We have this from Barclays struggling with some of perhaps pay when it comes to the investment bank. We have Deutsche Bank down 10% on the week over some of those commercial real estate jitters. How do you judge the attractiveness of the European banking sector right now?
I mean, there is no doubt in our view there is value in the space. I think what the market is struggling with is a growth story for the banks. I mean, we do think the market is underpaying for fairly strong balance sheet and the possibility of a recovery in the credit cycle. I mean, definitely we see some, early sign of pickup in European growth. We start to see lending condition picking up, and rate cuts ultimately should bring some life back into the credit cycle. So volume might pick up, but of course, that's going to come with some pressure on margins. Last year was all about margins support and boost earnings expectation. We have passed peak margin, and you need to see some degree of recovery in lending volumes for earnings to improve further. So we do like banks as a sector in Europe. Of course, we have some preference within the sector. We like banks in periphery. We like the potential for capital return, buybacks, dividend. But I think the market needs to see some strength in activity in lending volumes, I think, to kind of move beyond the kind of concern about margins.
Well, certainly, that investment banking arena is going to be hotly contested this year. If we hit the bottom at the end of last year, where is the contribution for this year? I'm interested to talk about valuations. You say valuations, strangely enough, excluding US tech, do not look stretched. And you specifically talk about European on a PE of 13. So if the US tech valuations may look a little bit stretched, do I look to deploy a little bit more to Europe as a catch-up on a hedged basis, I presume, for US investors?
Yeah, I mean, to be clear, I don't think valuation is a big issue for the US market. I mean, as long as AI and tech deliver such strong growth, I'm not sure valuation will be seen as a big issue. But of course, I think the optionality for whoever believes in some kind of soft landing and improving cyclicality is not so much in tech, and we think there's much more value in other parts of the market, whether it's small caps or international equities. And yes, European equities are not expensive. They're 12 times earnings, which is slightly below long-term average. And look, the structure of the index in Europe gives you some leverage to the global economy. So no one is going to buy Europe because Europe is cheap. People need to see some degree of strength in the global economy. And if investors start to buy into some kind of recovery, I think Europe might be seen as a candidate to get some exposure to that. So US is an investment, Europe is a trade. You buy Europe when you see, green shoot in the economy, and we start to see some kind of improvement, which might help Europe to unlock some of the undervaluation.
Okay, Emmanuel, thank you so much. Going with the flow, that is Barclays' Emmanuel Go on the very latest on markets. Other stories trending on your Bloomberg terminal this Friday morning. The U.S. Justice Department investigation into President Biden's handling of classified documents found he knowingly stored and disclosed classified information after his vice presidency. The DOJ found the conduct improper, but stopped short of charging him with any crimes. President Biden, however, pushed back on how the report raised questions on his age and mental acuity.
My memory is not good. My memory is fine. My memory, take a look at what I've done since I become president. None of you thought I could pass any of the things I got passed. How'd that happen? I guess I just forgot what was going on.
Meanwhile, Donald Trump suggested that the Supreme Court would side with him in the 14th Amendment case at his caucus last night at the night watch party in Las Vegas, rather. The former president dominated the Nevada caucus, notching another victory as he closes in on the Republican nomination. The Supreme Court heard Trump's appeal to remain on the 2024 ballot.
Our Supreme Court hopefully will be doing something in terms of helping our country and preserving democracy. We have to preserve our democracy. And I think they had a very, very interesting day and a very beautiful day, perhaps. I think it was really a very beautiful sight to watch.
Coming up, Putin speaks to Tucker Carlson in the leader's first interview to Western media since the Ukraine invasion. We discuss on Bloomberg.
And we're going to get more on that breaking news ahead, with Barclays planning to hand dozens of the lowest performers within its investment bank a big old goose egg. Zeroing out, it's a move of no bonus at all that threatens to complicate efforts to rebuild the advisory unit.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
I view the markets as fundamentally broken. Like the number
fundamentally broken. That's a big statement.
Yeah, there's value is just not a consideration for most investment money that's out there. There's all the machine money and algorithmic money, which doesn't have an opinion about value. It has an opinion about price. Mm-hmm. Like, what is the price going to be in 15 minutes? And I want to be ahead of that.
And that was Mr. Einhorn talking on the Barry Rizlitz podcast. Now, this is interesting. This is an accusation. We are all so fervent, aren't we? You know, in Mag 7, you want your return. You want that huge alpha to come from the Mag 7. It's almost as if the investment community has gone passive, tracker, and we've forgotten, actually, to talk about your favorite subject. Not so much small caps, but value.
I think this is an interesting argument. Look, people love to rail on passive investing. I don't know if you remember all those years ago, who was it? Bernstein saying that passive investing is worse than Marxism, which was something that grabbed a lot of headlines at the time. But the idea here is that if you're obsessed, if you're a passive investor just buying the index, or maybe you're an algo that's just sensitive on price, if no one's looking at the value small cap type stocks, who's going to bid them up? So even if you like the stock, everyone else is passive.
But it's about the wall of money that's railing against you.
Yes.
If the wall of money, if the flow of money is all concentrated in the higher end of the market, the flow will never, ever deviate. This is what he says. Value is not just a consideration for most investment money that's out there now. There's all the machine money and the algo money, which doesn't have an opinion about value. Right. It has an opinion about price.
Can I be honest, though?
I expect Danny to be honest every day.
The thing, though, is it's so hard for active managers to outperform the benchmark, especially value investors. So can you blame people for buying a cheap passive fund that's going to outperform and be cheaper? Can't blame them.
No. The value industry has gotten completely annihilated.
Yeah.
So says the Oracle. As opposed to me. Okay, look, that is all about markets being fundamentally broken. The world geopolitics at the moment is a febrile place. So let's talk about the Russian President, Vladimir Putin. Speaking to Tucker Carlson, it is the leader's first interview to the Western media since the Ukraine invasion.
If you really want to stop fighting, you need to stop supplying weapons. It will be over within a few weeks. That's it. And then we can agree on some terms.
Joining us now is Greg Sullivan for Bloomberg. Look, talk us through what changed. What was he willing to talk about, and why did he choose to sit down with Tucker Carlson now? Is this a message to the West?
That's a great question. Obviously, this is President Putin's first sit-down with a media figure in the West since the beginning of the war in February of 2022. And Tucker Carlson seems an obvious choice in many regards. Carlson, both when he was at Fox News and afterwards, has used his media platform to defend the Kremlin and to question U.S. support for Ukraine during its war. Putin was clearly seeking a friendly platform where he could convey his message potentially directly to the U.S. And in Carlson's Carlson, he had that. It was a long interview, about 2 hours, and Carlson rarely pressed Putin, even when at times he went on long, rambling conversations. So here he had somewhat of an alignment in his thinking and a way to give out his message to the West.
I mean, there are a lot of different topics that are crucially important to the U.S. You think about the jailed Wall Street Journal reporter in Russia, issues like, I mean, just ending the war in general. On this, when Carlson pressed him, did Putin say anything new?
You know, yes. So Putin was pressed about why he potentially started the war. But what was interesting is he did something he often does for domestic audiences. He gave a long history talk that actually clearly annoyed Carlson at different points. But he tried to portray his thinking on history and Ukraine's role in that. But what we do know is that he does not see Ukraine as being independent. He sees it as very much in Russia's sphere. And he thinks that the Western meddling is very much out of order. The U.S. and its allies should not be interfering in Ukraine, should not be supporting it, and most of all, he does not see a role of self-determination for Ukraine in its own future. So he reiterated a lot of that. He also said that Russia had not yet achieved its goal in Ukraine and warned the U.S. about putting troops there.
Well, of course, you've got the Ukrainian president dismissing his top commander, shaking up his war team. Did we hear any message on Ukraine? I mean, the line in the story is this. Of course, we're talking about the Russian-occupied land of Ukraine. And this is what Putin said. I said, let them think how to do it with dignity. There are options if there is a will. Of course, this is about trying to settle a negotiated peace and an end to the war, with Ukraine accepting some territory give up to Russia.
You know, that's a very good question, and I think that's exactly what people were watching this for, to see what would be said. What's interesting, we reported, Bloomberg News reported about a month ago that there have been signals sent on possible talks. But what we've heard from Putin doesn't really deviate from what we've heard before, which is that he said, of course he's willing to talk, but on his terms. Here he said that the U.S. should stop supplying weapons to Ukraine if they wanted negotiations. But are the terms that Putin is laying out for talks ones that the U.S. or Ukraine will capitulate to? That's the big question. It doesn't seem likely at this point.
Greg, thank you so much for that. That is Bloomberg's Greg Sullivan on the conversation between Putin and Tucker Carlson. Okay, coming up, we're going to have a little bit of sport chat for you here on Bloomberg Brief.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Manus, we talked about the story earlier in the week that Hong Kong fans were furious that Inter Miami came to the region and Messi didn't play. They were demanding a refund. Adding insult to injury was that Messi played a few days later in Tokyo. Well, a little bit of a win maybe for the fans.
Well, if you're a fan out there, 38,000 of you who went to that event, you're getting 50% of a return. But Tablet, I mean, this is a PR disaster for them. Of course, they got grants. They got extra grants from the Hong Kong government, and they're going to have to forfeit nearly 16 million Hong Kong dollars back to the government because of the fiasco.
Yeah, it's a record loss for them. This is also what they said in this decision, Manus. Tatler Asia writing, we put our blood and sweat into bringing a world-class football match to Hong Kong, and we were let down along with all of you.
And then Messi went on Weibo on Wednesday.
Right.
And he said, look, he regretted being unable to play in Hong Kong. It was due to an injury in his adductor muscles. So, you know, they are conscious of the kind of bruising PR that this can do to it's a new team. Inter Miami's owner is the billionaire Jorge Mas, and they want it to be worth $1.5 billion. They don't want PR disasters like this. I just want a pink.
You would look really good in that.
Do you think?
Yeah, I think you'd look very good. The thing, you know what's crazy?
Do you think I'd rock Cerise pink in a Messi jersey?
I have to say, it's so crazy. I was in Vietnam last year, and I saw two people in the airport wearing those pink Messi jerseys. Do you think anyone in Vietnam actually watches? It's just so crazy, the reach that Messi has, and now Inter Miami has.
He's out there. Can I just say I wore pink for the World Cup final?
Oh, did you?
Nice sort of shirt. Got a little ball and practiced my header.
You can do a repeat in New Jersey in a couple years.
Now you know what to get me. I'm a Messi jersey. We're going to talk about, what are we going to talk about? Hermes bags.
Messi jersey, much cheaper than that.
Yes,
so
exactly.
I'll take that trade.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
U.S. stocks hit another record with the S&P briefly topping 5,000. Investors await the U.S. CPI revision data due later today.
L'Oreal slumps after sales disappoint, but Hermes surges as it weathers the luxury slowdown.
And hedge funds must share more about their investments, borrowing and counterparty exposure under the new SEC and CFTC rules.
Manus, I got some bad news for you. We can't break
Not
out
on a
our
Friday.
I'm sorry, we can't break out our 5K hats yet. We can't get them made yet. We didn't get there. We didn't close there. I don't think it's allowed.
We know what Danny's going to be doing this weekend. Getting me a little baseball cap.
Well, it depends what this equity market does. If futures are any indication, we might just get there. We're up about 0.1%. I mean, you can't really use the level on the futures market for the indication whether or not we'll get to 5K. This thing is at 5K, but does the cash market get there? We have some earnings to sort through. Yesterday, it was a good earnings picture thanks to ARM. 48% rally, a monster ad, a valuation of $38 billion. Emmanuel Coe from Barclays tells us that he does like the more value names, the more small cap names. They have some juice left in him. That positioning is not stretched there. Now, when it comes to Europe, we're going to talk about this in a moment, so I don't want to front run it, but it's a story of two different luxury stocks. L'Oreal sinks this morning, Hermes surges. We're going to get into that in just a moment, Manus.
Okay, well, let's talk about these bond markets. Finally, we're done with these auctions, 3s, 10s, 30s, and they turned up in size. 10-year paper this morning. We've drifted higher through the week, backing up through the week because, again, the Fed rhetoric has been very, very clear. Barkin was here on Bloomberg yesterday and again throughout the day commenting that they want to see a broadening of the disinflation narrative. They don't want a 1986 redux where inflation got trashed to the bottom, and then in 87 they had to ramp up rates. They don't want a repeat episode of that. Yields 416 at the moment. The dollar's flat. I'd hardly call that raging up. What you've got is, I suppose, the bears are being forced to capitulate in many ways, and this is what Bank of America say. The hedge funds are bid up on dollars. They're bid into the dollars. They're forcing a rethink for the bears. Brent comes back. I mean, we put on 6% this week, Danny, so just at the moment, 81.61. Netanyahu dismisses talks of any potential ceasefire in the world. So that in some way helped this oil market this week.
Well, I do have good news on this Friday. It's Friday, Manus, so we get to talk about the flow show.
We do indeed. And this is where you're seeing, again, another serious amount of flow into the money market fund, 6.02 trillion in the week. There you go. We walk, we talk. This is how we actually sit down.
We do it all.
Would you like a repeat of that again?
That was fun, Manus. No, but okay. So
that was live.
That's what we call live TV. So $40 billion. See, there's the chart. There we go. $40 billion put into cash, according to Bank of America. Equity still had the largest outflows in 5 months. We're still going to cash, but there's a tinge of risk there.
There's a few nervous institutions out there. Prime funds, and this is the other piece that we saw at the bottom of this. Prime funds, which are slightly risky, I wouldn't call it runaway risk. Commercial paper had a little bit more of a pop in terms of money flowing into them. So what does that say about risk?
Yeah, Hartnett, though, says that after a 24% rally, that positioning is going to flip from a tailwind last year to a headwind this year.
Positioning, the constant burr.
Right, but everyone's piled into big tech, so it could easily flip the other way around this time.
That was all quants.
How dare you disparage the robots, man? They're going to take our jobs one day. You have to be kind.
There's absolutely no way AI is going to replace me. Well, not for this month, I hope. Let's talk about Europe. You touched on it very, very briefly. Yeah. It is about luxury. It's about Hermes. It's about Estee Lauder. And it is a tale of two earnings. Shares of Hermes hitting fresh highs, fresh records as sales jump. L'Oreal, you've already shown it, Danny. The drag is Asia. Let's get to Andrea Felsted and differentiate between the two. She's there for Bloomberg Opinion. In the end of the day, this is about the super rich being price elastic. They just don't care about price rises, or do they? Andrea, good morning.
Morning, morning. I think they do, but they're still buying. You know, we had Kering yesterday, owner of Gucci, Hermes, L'Oreal. This is all about who you're selling to and where. The super wealthy are still spending despite the price increases. As we know, the aspirational luxury shopper, particularly in the US, has pulled back. We have also got China, where the aspirational luxury shopper is squeezed by some of the economic issues in China, whereas the VIP clients are still spending. They are traveling, but they're traveling less than they did before the pandemic. So that is having an impact on duty-free. Plus, you've got a push to keep them spending at home in places like Hainan.
Is there not some element, Andrea, where it's just about scarcity? Manus and I talked earlier about the week about those crazy little Apple VR goggle things. Stick with me here because they're hard to get, and we're seeing them resell on the second market for 5,000, crazy amounts. It reminds me of Hermes' strategy. You create scarcity and you create demand. Is it also about that? Not just the fact that it's very expensive in the ultra high net worth luxury, but if you've been on a wait list for years, who cares what your finances are? If you get off it, you're going to buy the thing.
Yes, indeed, there are wait lists for the most iconic product. Hermes has capacity constraints. It can't keep up with demand. That means that when times are tough, it can still keep performing because it's got this backlog of customers. And if you get the call or the email and it says, your Hermes wish has been fulfilled, we have your Birkin bag, but you think, I haven't quite got the money to buy it, there'll just be someone else who's next on the line who will.
But what about us? I mean, what about us?
Good question.
I mean, I say us. I mean, I can't speak for the Duchess of New York. but you know, well, you've got the English passport now.
Yeah.
You know, aspirational luxury. Just redefine the aspirational luxury. It's up to what, £1,000, £1,000,
Yes.
$1,000?
I think £1,000, up to £1,000, $1,000, which still isn't a small amount of money. That would be classed as more aspirational. And what all the luxury brands want to do is they want to make their products more desirable, and they want to make them appeal. They want to make them more expensive, more desirable. They want to make them appeal to that high-end shopper. That's what Kering spent a lot of time talking about yesterday with Gucci. We've grown with that aspirational customer, but we want to grow with the high-end customer too.
What about when it comes to cosmetics? You mentioned that China wants to promote domestic growth, which makes it a little bit harder for the Chinese traveler. Do we see things like upstart luxury Chinese type cosmetics that might inch the likes of L'Oreal out of the market?
Yes, we are definitely seeing that. That has definitely been a trend for a while. And as more Chinese consumers are staying at home, they are more drawn to those kinds of products. And I saw some research before Christmas into what young Chinese high net worth women want, and the growth of that domestic beauty market is definitely a factor that is challenging L'Oreal and Estee Lauder.
Where are we in terms of the American numbers for Estee Lauder? Because, for L'Oreal, I should say, because we saw Estee Lauder cutting back here. I mean, am I comparing apples with apples here in terms of Estee Lauder and L'Oreal? I mean, we see Estee Lauder cutting 5% of the workforce here. So how does that marry up?
It's all about the desirability, as in luxury. It's all about the desirability of your brands, attracting young consumers. And while Estee Lauder did very well a few years ago with products, with brands like MAC, there is a question mark over whether they have enough of the young products to appeal to that sort of beauty-obsessed TikTok generation, which, quite frankly, is a challenge for all of the cosmetics companies. There's a bit of good news on that front. We've had a very clean beauty look. And recently we've had this mob wife aesthetic, which is all about going back to quite ostentatious makeup, the contouring, the color cosmetics that we saw in 2016. If that catches on and there is a beauty refresh, that could actually be very good for these companies. The trouble is, these TikTok trends sometimes don't last very long and they don't always catch on.
Manus, are you aware of this mob wife aesthetic? Do you know this?
Mob wife? No, I'm not aware of mob wife aesthetic.
The idea is you wear a big fur coat, you put on all of the makeup, you look like Tony Soprano's wife. That's the aesthetic.
Big hair.
Yeah,
big makeup,
hair.
big hair.
I think I'm close there, you know,
This
I'm not too far.
This is an incredibly dangerous territory for anybody to step into. I'm going to leave big hair and coats and Tony Soprano's wife to you two.
Andrea, we're going to let you go before we get Manus in trouble. Andrea, thank you so much for joining us. That's Andrea Felstead. Okay, quick check on your currency market as we head to break. Treading water today. We're going to get the CPI revision out at 8:30. Does that shake up markets like we saw last year, Manus? So in the meantime, dollar flat, slightly bid, while euro and sterling are lower by about 0.1%.
Listen, we could get a shock on the CPI revision.
Oh, we got it. We literally got it this time last year.
And Waller, I think you sent me the story through this morning. Waller mentioned that very, very clearly.
He did.
So let's see. Don't forget, it was like a bomb that went off in inflation, and it was ratified in the CPI in the first sort of couple of weeks of 2023. Okay, coming up on the show, no bonuses for Barclays. We broke that. Donuts abound in the investment bank. Have you been zeroed? Are you set for a bounce at Barclays? This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Manus, we hit on this scoop to start the show. Barclays is planning to give out no bonuses to dozens of the lowest performers within its investment bank at a time when they're trying to rebuild the unit. Let's get over to Jenny Surain from Bloomberg. Jenny, usually this is a thing banks would want to do if they wanted more attrition in the ranks of the lower performers, but it's a time of transition. So how unusual and perhaps what does the timing say about this?
Yeah, no, I think that's exactly the tension that's really interesting here is, you know, this is a bank that has been very vocal about wanting to rebuild after losing a lot of, you know, a lot of its top investment bankers early last year. And so to now come back with a bonus season that's, you know, especially brutal, it really does hurt morale and obviously risks everything that they've been trying to do with this big rebuild. And so definitely a departure from what you normally see from banks. It's not unusual for banks to give out, you know, they're called donuts or bagels in kind of Wall Street lingo, but usually it's done very sparingly and really done to folks who you kind of want to see out the door. That's not the case here. You know, our understanding is that this is large swaths of Barclays investment bankers being given these donuts or bagels, and so really interesting time for this bank to try to continue with its rebuild.
I mean, the two people running that side of the business are Taylor Wright and Cathal Deasy. They, according to our sourcing, they went into their teams and they held on to the rainmakers. They paid up and looked large, excuse the pun, but they spent part of the pie retaining star talent, which is a fair enough strategy. Retain your star rainmakers, but that means that breeds resentment. I've worked on floors where this really breeds resentment, and people leave. You do need the mid-tier to deliver. Ironically enough, rainmakers are wonderful, but you do need worker bees as well.
Yeah, I think that's exactly right. And that is, to your point, what our sources were telling us was just that all of the efforts that they went through last year to rebuild and not just retain folks, but really go out and hire folks. I mean, those efforts worked. They were able to add dozens of managing directors and directors. But now at the end of the year, kind of when, you know, the rubber meets the road, you see that is, you know, potentially going to complicate the folks who decided to stay and yeah, could ultimately really undermine a lot of what they've been able to do here.
Well, Jenny, if the reasoning behind this is the investment banking struggling, I love what the head of IR said at the last earnings, that there's not quite enough volatility for the markets, but a little too much for banking. So it's this awkward period of volatility not helping either side. We get an investor update later this month. Are they going to be talking about the revival of the investment bank? Are we finally in the sweet spot?
I think that's what everyone's hoping for. So at this investor update, what they've talked a lot about is that they're planning to say, you know, the investment bank right now, it gets a lot of flack from investors because it takes up so much capital relative to other parts of the bank. They love their investment bank. They think it's a really high-performing unit. They want to keep it. So I think their goal now is to just rebalance that and just invest in other parts of the bank. And so you actually saw this morning, Barclays announced that they are buying Tesco, their retail bank offering here in the UK. And so you see them trying to make these steps where they won't de-emphasize or won't pull back on the investment bank, but they'll just make the other parts of the bank bigger. And that way the share of the company that the investment bank takes up isn't as large. And that just helps them a lot on the capital front. And so I think we'll see more maneuvering like that because everything they've said so far really is that they love this investment banking unit and they want to see it grow.
They may love it. Every CEO for the past 20 years at Barclays has had a pain literally from activist investors all the way around. Shrink the IB, shred the IB, get rid of people. I mean, you think of the activist investor Edward Bramson writing letter after letter. So this is a perennial issue at Barclays. What is your investment bank? What's the purpose of it? And what is the size? Not that I know how to run an investment bank. There you go, lecture one over for a Friday. Jenny, thank you very much, Jenny Serrain there. But it does bring a much bigger question about what is the purpose of your investment bank.
Right.
You look at organizations like UBS, where Amati downsized the investment bank aggressively, and he made it a purpose functioning to feed wealth management. And how much risk do you want to take?
Or you look at Deutsche Bank, which when it was the problem child of Europe, completely axed equity trading, focused on FIC, and so now they have a much slimmer investment bank. Barclays is going to have to make some hard decisions like that too.
Okay, let's see what the investor shareholders want. Let's talk about the other finance story this morning, and this is the U.S. regulators will start to require hedge funds to confidentially share more information about their investment strategies under the new rules that were just approved. So let's bring in Charlie Wells. Charlie, how invasive is this? How radical is it? How big a shakeup is it?
Yeah, Manus, this is a really big deal. I mean, this is some of the largest increase in regulation on private funds since the financial crisis. So this is not going to make hedge fund managers happy. These rules were approved yesterday, and they basically require funds that have $500 million in net asset value or more to do a lot more granular reporting. So they need to sort of report on how different segments within their units are performing. They need to get a lot more specific. And interestingly, they need to talk about crypto, not just crypto, but also litigation funding. So a lot of these kind of strategies that have evolved over the past years, that have grown, they're going to have to disclose those to not just the SEC, but also the CFTC.
Well, the Managed Funds Association, which represents hedge funds, we've had the CEO of that, Brian Corbett, on the show. He's railed against disclosures on the show with us. He also added to this that it will put sensitive information at risk, drive consolidation, raise the cost of investing for people like pensions, foundations, and endowments. That's a good way to scare people, saying that your pension's going to be more expensive.
What's pension?
Yeah, exactly. What's the flip side of this? I mean, is this more effective at managing risk if you have more disclosures?
I mean, look, regulators want more information, right? You know, the private funds industry has just ballooned over the past few years, and regulators feel like they just don't have enough information. And I mean, when you think back to the financial crisis, you think about the risk that was inherent in the mortgage market and the lack of information and the lack of disclosure that was there. I think that really is the thinking behind the SEC, behind Gary Gensler, and behind the CFTC. But again, you get Republicans and you get the industry talking about how onerous this is, and not just how onerous this is, not just how expensive this could potentially make. What are already some pretty expensive fees for investors potentially go up, some consolidation, but also this idea of this kind of deluge of information. And sometimes when you see this with regulations, not just in the financial industry, but in other spaces, you know, you give consumers, you give regulators additional information, and it's almost too difficult to parse through. There's just too much of it. So that's one of the points that's coming from the other side.
And then I feel like we all go back, all roads lead back to Einhorn saying that the passive people are ruining this market. I mean, you're going to go to passive if your fees are going to go higher. It's going to get worse.
It's true.
It's going to get worse. Charlie, thank you very much for joining us. That's Bloomberg's Charlie Wells. Okay, quick check on your bond market. Manus, you put this really well, that yields have been creeping higher, kind of underneath the radar all this week. Treasuries sold off yesterday, 3 basis points yesterday. We add another 1 basis point. Also, yields on European debt also creeping higher, be it bonds about 4 basis points yesterday that were treading water this morning.
Look, we're going to dig into this on the slate, but it is about the CPI revision. Take your mind back to last autumn. It was last January, it was 3.1%, and then it was blown out of the water. It was shown to be a head fake, really. We're going to talk about the market-moving events. We got there, it's Friday. Reunited. We didn't win.
Yeah, our first week.
Yet. Welcome home.
That's ominous. Thank you, Manus.
You're welcome. Okay, we'll take you through the slate in just a moment.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's get you set up for your last trading day of the week. Here's what's ahead. The CPI revision number that Fed Governor Chris Waller said that he'll be looking to confirm the progress in taming inflation comes out at 8:30 a.m. Eastern. Then we're going to hear from Dallas Fed President Lori Logan. That is at 1:30 p.m. And then we're going to get Pepsi earnings before the bell. And man, it's usually a thing that's quite wonky. It's really about that CPI revision because we're scarred from what happened last year.
Yeah, I mean, it was adjusted higher, and then the CPI, if you take your mind back, really popped up over 4%, and that's what unsettled the bond markets. Whether we get that again, we'll see. But have a look at this. These are some of the movers. Pinterest follows Snap. Bring back your memory. Snap was down 30% the other day, posting disappointing holiday revenue. Of course, Snap suffering from where do you spend your advertising dollars. Expedia, you're not booking enough. Falls sudden CEO change. Fourth quarter bookings, room night growth. Disappointed on Expedia. Down. It's brutal. When you disappoint in this reporting season, it has been brutal. And Affirm down 10.4%. The buy now, pay later firms 2024 forecast for the annual transaction volume came in below expectations. And analysts see that slowdown in volume, Danny, going into the second half of the year. These are all little micro, mini time bombs on sentiment, aren't they?
They certainly are. And Manis, we just did the day ahead, and we missed a crucial thing that's coming this weekend. It's the Super Bowl. It's the Chiefs versus the 49ers. It's 2023 again. Are you going to watch, Manis?
No, I'm going to be in bed. I'm going to be so
too.
excited about getting up at 3:30 in the morning because I'm not going to spend, what is it, $9,000 on a ticket. Would you spend $9,000 on a ticket for the Super Bowl?
No way, no way, no way, no how. I don't think I'd spend it on any live event. It's almost 10,000 actually, 9.8K.
You're being tricky now.
Sorry, I'm a stickler. It's the most expensive ever, according to TickPick, who is a reseller. They say it's because it's in Vegas and that's attracting everyone, but we know the real reason people are spending for tickets.
Taylor Swift.
That's it, right? Why else?
You really think it is that?
I mean, who cares?
Why would you spend $10,000 to be in a stadium where perhaps Taylor Swift might be there watching her boyfriend play
Because maybe
football?
you'll see them embrace at the end, and it'll be a sweet moment, and you want to say,
Danny's
I was
full
there.
of romance at the moment. She's back in New York.
It is the pop culture
Young
moment.
Brooklyn Bridge with the husband saying, isn't it lovely, we're home. Would you spend $1,000 for a night at the Bellagio for the Super Bowl?
No, I could buy some cool outfits for $1,000. I don't think I'd do it for a night at the Bellagio.
We'll be watching the Super Bowl. We'll bring you the results on Monday.
look at the number of women that want to learn the game, young girls that are joining on the tee, really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Every week that passes, the expectation about how much the Fed's going to cut rates gets less.
It's going to take more time for cuts than people would like.
We have a Fed that we've had some walk back of if March is on the table or not, but I think the base case is still their next steps are easing.
We're in the same camp as the Federal Reserve. We need to see more data.
We look at rates and where the Fed is today. The Fed has gotten us to where we need it to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Brace yourself. Bramo hot take on the President's news conference yesterday evening, coming right up. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.1% on the S&P. Was the market even open yesterday? The trading range was so tight. At a close on Wednesday within 5 points of 5K, on Thursday within 3. We hit that milestone for about a second, Bramo, and then we backed away from it.
It basically was pushed over there just begrudgingly by a market that really doesn't want to really have any direction, because why would you right now? People are worried about momentum given the fact that we've seen this incredible rally, and yet high valuations, questions about Fed rate cuts and just how many can happen, and concerns about profitability and whether expectations are too high, all plaguing the market.
On course for 5 consecutive weeks of gains on the S&P 500. With all that in mind, look at the bond market. Yields higher on the week, 2-year, 10-year. The bulk of that came on Monday, though. Then we've got to pass through the data. Then we can talk about the auctions. The data, it was Monday. It was a really, really solid ISM services read. Jobless claims yesterday, the right kind of downside surprise, 8:30 Eastern time. Don't usually do this. We're going to be talking about inflation revisions. They were important last time around. They're more important now. Governor Waller last month, this was the quote: "My hope is that revisions confirm the progress we have seen, but good policy is based on data and not on hope."
Happy annual revisions to seasonal adjustments for monthly CPI day. That was basically what I came in thinking. We're really going to care about this. Well, Chris Waller cares, so we care. And basically, if it changes to the upside like it did the last time around, does that materially change the view? I've read note after note basically saying this could be a big deal, but it won't be. And just wait for next week's CPI report.
Priya Misra, JP Morgan Asset Management, said it's important. Ellen Zedner of Morgan Stanley said it's important. So important, this Fed can't commit to easing until they really get their hands around the trend. I think you saw that from Chairman Powell in the news conference last week. Wasn't comfortable enough yet to suggest that maybe this was all said and done, maybe still concerned about one-off factors bringing down inflation, and worried still about the prospect of inflation stabilizing above target.
What I've heard from every investor, though, who's come on, frankly, is that nobody is pricing out rate cuts this year. They still are pricing in 3, 4, 5 even rate cuts later this year as there is some weakening. So here's a question. What will it take for the market to wake up to the view and the projection that the Fed has put out there? other than just say the Fed is wrong and we're right, because that's essentially what the market is doing, despite the pushback and frankly, despite some of the better than expected data.
Let's talk about this bond market. So yields up this morning by a single basis point, 10-year 4.1657. We had a 10-year auction earlier this week, 42 billion, really decent. 30-year auction, 25 billion yesterday, went pretty well as well.
All of them going pretty well, despite this concern about the budget, despite the fact that interest payments will outstrip some of the military spending in the United States this year. All of this doesn't seem to be playing into the bond market. Why? Well, person after person has come on and said, bonds are back, we can get some income. We have a guest coming up who's gonna say, there's something for everyone, pick your poison, you've got it, you've got income. And so people are trying to lock it in at a time where there's some real concerns about long-term inflation and the deficit.
I'm sitting here smiling. We're 3 minutes into the program. I cannot believe we still haven't talked about it.
Okay. I know, I'm waiting for you to get to it.
Here we go.
Okay.
If you are running to be the president of the United States, do you want to be described as a well-meaning elderly man with a poor memory?
Do you want to not be tried for something because it would be difficult to convince a jury that they should convict you of a serious felony that requires a mental state of willfulness? Oof. Do you really want to have that? Look, take a step back. There are a lot of questions about this. President Biden responded by saying, I am not a man who has problems with my memory. And the Mexican president, Sisi, of Egypt, is, and that was a problem. Here's the issue. On Wall Street, executive leadership is defined by creating a cadre of people of succession, where you can pass the business down. You have a sense of who comes next. The executives in charge of this country have not done that. And that, I think, is a real problem and a liability. And frankly, in betting markets, people are starting to question whether Biden will really be the nominee.
It's so well said, and what a 24 hours it's been for US politics. The compare and contrast is amazing. Waking up this morning, the front pages, every single political note, every newsletter I'm receiving this morning is about Biden's memory. Nobody is talking about the fact that we had a Supreme Court hearing yesterday about whether the former president could even run in the election this year, which is kind of amazing. If you thought that was going to be a bad day for the former president, think again. I would say yesterday was a phenomenal day for the former president. It's the sitting president that's getting all the bad headlines this morning.
Even though we're actually talking about states not wanting to put the former President Trump on the ballot, what I find interesting, though, the Supreme Court actually crossed partisan lines. So normally they're the cadres of liberal and more conservative justices. And the majority of them, including some that are more considered liberal, said, you know what, this is a federal issue and he should be on the ballot. And this is not something that states can decide state by state. So that at least was less politicized in terms of trying to create a democratic grounding. That said, the fact that we're not talking about that and that we're talking about memory issues, to your point, well said. It's a problem for Biden.
Stay tuned for more of this throughout this morning. Let's kick it off with a price action. Equity futures on the S&P 500 positive here by 0.06%. There's a lift. Yields are higher by a single basis point, 4.1657. The euro just a touch weaker against the dollar. Euro dollar 107.64. Coming up this hour, Jonathan Stubbs of Berenberg with the S&P 500 hitting yet another all-time high. Jeanette Lowe of Strategas as President Biden confronts more questions about his memory, and Bloomberg's Deborah Aiken as Hermes defies fears of a luxury slowdown. Now, Lisa, I'm trying to work out Hermes story or luxury sector story. Feels like the former and not the latter.
It's because you have an incredible bifurcation in luxury. And that I think you can see with the fact that Hermes is planning 8 to 9% price hikes on their items at a time where you're seeing L'Oreal and Estee Lauder, you're seeing Kering or the Gucci parent company struggle. So it's sort of the haves and the have-nots. Who caters to the highest end of high-end luxury? You're doing great. Everybody else, and that sort of seems to be the theme.
I get the feeling this is not the buy now, pay later crowd buying those Birkin bags, right?
Well, did you see the Affirm? They actually came in lighter than expected. So I wonder if some of those people are pulling back, exactly to your point. Maybe this isn't the entry-level type of luxury.
Not at all. Deborah Aiken with, I think, quote of the morning on this company, and we'll speak to her in about 25 minutes. High luxury league of its own. That stock is up by about 4.5%. We begin with our top story. The US stock market rally continues. The S&P 500 hitting 5,000 intraday, closing just shy of the milestone. Jonathan Stubbs of Berenberg with a warning, writing this. The broad US tech group presents valuation headwinds. Absolute multiples have expanded significantly, and the relative PE for US tech versus global equities gives a sell signal. Jonathan Stubbs joins us now for more. John, let's get straight into it. It gives a sell signal. Does that actually mean you want to sell?
In markets, in life, things are often more complicated. We have valuation signals which we have to respect. which tell us to sell US tech at this point. That's pretty clear. We also have sort of momentum signals from price and earnings, which will tell you the opposite. So I think investors are caught between the two schools, and for the moment, momentum's winning. We run strategies which try and capture both of them, and we end up at a bottom-up level with some exposure to tech, but also with broader exposure to other parts of the market as well. We think that's a more sensible path to take.
NVIDIA earnings come out in about 2 Wednesdays' time. I think we're all asking the same question, John, whether the earnings power of the Magnificent 7, 6, 5, 4, pick your number, can continue to power this rally stateside.
Well, if you break the 500 into the Mag 7 and the SPX 493, the Mag 7's outperformed the 493 in earnings terms by around 90% since Feb.
We seem to be getting some sort of technical
We
issue.
lost him there, have we? I'm not
think-
sure what happened with that
He
shot.
just turned it off. He just said, I'm done. I'm sick of talking about the Mag 4, Mag 3, Mag 2.
Jonathan Stubbs of Berenberg with a connection issue. We'll try and re-establish that. Do you know where he's looking? Elsewhere. Jay Poloski doing the same thing. Europe, international equities. And the question I wanted to ask John in just a moment was about European banks.
Yeah.
How constructive is he on the European lenders? Can you really look to Europe and what you're buying? And I remember what you said a few weeks ago. When you're buying Europe, what are you buying? Skinniness? Weight loss drugs, right?
You're buying,
Luxury goods and financials.
Skinniness and luxury. I mean, essential and financials. Maybe is that what people want? I mean, Jay Pulaski can come on and talk about why that's a great trade. This has been the Widowmaker, and we've seen this continually. Although I do wonder if there's a new focus on efficiency and maybe higher rates. Again, though, people have been betting on that for so long. The fact that they're being forced into trades that they have previously left out to dry shows you that people are feeling a bit risk on.
Let's turn to the price action. Equity futures on the S&P 500 just about positive by 0.1% on the S&P. There's a little bit of a lift this morning after closing just short of 5K at the close yesterday. The bond market yields just a little bit higher by a single basis point, 416.57 in the FX market. The euro 107.66. We're negative on that currency pair by about 0.1%. Lots of pushback to the old rate cut call throughout the week from Fed speakers. Barkin with us yesterday talking about nobody wants inflation to re-emerge. President Kashkari early on in the week said need a few more months least of inflation data before easing policy. Collins admitting that rate cuts were likely this year. And then we heard from Governor Kugler. Haven't heard much from her so far in her term on the FOMC, indicating little urgency to reduce borrowing costs. That seems to be the consensus at the moment.
Yeah, I think that was her first public speech since she was appointed, since she was confirmed in September. The point that I'm looking at, though, in markets is you're still pricing in about a 20% chance of a March rate cut. Why? Is this real estate worries? Is this belief that we have more weakness out there? You've heard, basically, the Fed all but tell us that they're not going to cut rates in March, and yet we still have a 1 in 5 chance of getting that in March. Again, this just speaks to a sense that people are expecting the Fed to sort of tilt to the dovish going forward, and that is the bias right now in markets. Does it come through? That is what I find really interesting.
A bit more Fed speak coming up a little bit later before the weekend and before CPI next week. I understand we can't re-establish that connection with Jonathan Stubbs at Berenberg, so if we quit trying, I think we've quit trying. John, we'll speak to you in a few weeks' time, I'm sure. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Supreme Court appears ready to keep Donald Trump on this year's presidential ballot. Justices cast doubt over Colorado voter efforts to disqualify him over his role in the January 6th insurrection. Both liberal and conservative justices questioned whether the Colorado State Supreme Court had power to exclude Trump on the grounds of the 14th Amendment. The court is set to reach a ruling on an expedited basis, which means it could come in the next several weeks. Treasury Secretary Janet Yellen says regulators are watching for risks stemming from non-bank mortgage lenders. She was speaking at the Capitol and cautioned that non-bank lenders risk failing due to their lack of access to the same deposits as traditional banks. Non-banks have become a major presence in the mortgage market, and regulators have continued to warn that oversight hasn't kept pace with their growing footprint across finance. The panel that blew off a Boeing jet during last month's Alaska Air flight showed signs it had moved prior to the accident. That's according to Senator Maria Cantwell, who was briefed on the situation by NTSB. Investigators found marks on the panel indicating it had shifted prior to breaking loose on January 5th. In a statement, Alaska Airlines said there was, quote, no indication of issues with the door plug prior to that flight. That's your Bloomberg Brief. John.
Hey, Danny, thanks for that. Just getting some earnings from PepsiCo. Let's look at the stock right now. It's down about 1.8%, Lisa. Your read on these numbers?
Just taking a look, it looks like snacks, people are buying more Frito-Lay chips, Mountain Dew, Gatorade, you'll be happy to know. They're looking at an earnings per share growth for the year, at least 8% on an adjusted basis, organic revenue 4%. Basically, this is within range, but again, within range is not good enough. As people look out, what you're seeing right now is consumer behaviors largely reverting to pre-pandemic norms. Key question, what about Ozempic? And so we'll dive into that later.
I imagine that a lot of people on the call are going to dive into that later as well. The stock is lower by 1.8%. The broader equity market positive by 0.1% on the S&P. Up next on the program, President Biden on the defensive.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine.
That conversation is coming up next, live from New York City. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Live from New York City this morning. Good morning. Welcome to the program. Equity futures on the S&P 500 just about positive again by 0.1% on the S&P over the last 3 days. I think 3 days of gains on the S&P 500, just grinding out day after day. An okay day of gains. Yields up by a single basis point. The 10-year 4.1637. Under surveillance this morning, President Biden on the defensive.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine. President of Mexico, Sisi, did not want to open up the gate to allow humanitarian material to get in.
That was awkward. Here's the latest. A heated exchange at the White House with President Biden angrily defending his memory after a special counsel report on his possession of classified documents described him as, quote, a sympathetic, well-meaning, elderly man with a poor memory. Shortly after, Biden mixing up the names of world leaders once again, referring to Egypt's President al-Sisi as the President of Mexico. Jeanette Lowe, Director of Policy Research at Strategas, joins us now. Jeanette, I know it's frustrated. You want to focus on policy. We do too. But this is the focus at the moment. What are you telling clients about here, particularly when people are still asking whether this is going to be the nominee for this election this year?
Well, good morning. I think, voters in particular have concerns about both of the current front runners for the nominations, so both Biden and former President Trump. And so that's something that it continues to be a concern as to whether or not there could be an opportunity for either of those two individuals to not be at the top of the ticket as we get towards November later this year. So I think that there's something that we do have to kind of always keep an eye out for, and that is that there could be a change potentially at the convention for either one of the parties. It's a very low probability, but it's not something that we're going to discount, that we do have to still kind of keep in mind and have that opportunity out there that there could be someone else who gets changed, either because of a health event or because of a criminal event or something like that. So it's something that we do have to keep in mind as we move forward into the election.
Jeanette, even if they are the nominees, can you just tell us whether ultimately you think this is going to be a traditional campaign? And by traditional campaign, I mean debates, people on the road all the time talking, or based on the latest gaffes, whether they're going to have to pull him back once again?
Right. I mean, I think this it's already an extraordinary election because you have a president who you have, first of all, former President Trump, who is running, who has a number of charges filed against him. You have this also a unique situation where you have the current president and you have a former president running against each other. You have a lot of concerns with Biden, whether he would actually be on the campaign trail. So I do think this is going to be quite a unique campaign cycle that we're looking forward to. And it might be very different. We do probably expect that there should be debates ultimately, but I think that things might be different down the stretch as to how much campaigning is getting done. You do see the Biden administration trying to get on the road a little bit more, but I think there'll also be some reliance on the vice president to do a lot of that for the president. So I think it is going to be quite unique, and we'll have to kind of take things a little bit differently than we normally would have, just given the unique circumstances this cycle.
Jeanette, we've talked a lot about how important it is to know who the president is going to be, to understand what the policy is going to be, whether it's antitrust issues having to do with mergers and acquisitions, whether it's tax issues having to do with sanctions on China and other nations. How frustrated are some of your clients, and how much are they paying attention to this to try to get any information on that front versus just the noise that we seem to be getting every day?
Well, and to some extent, what is actually helpful in this cycle is that we actually do know Trump and Biden rather well in the sense of what their policies are. So the difference this cycle is that you're not having someone new come in where investors have to think about what could be on their agenda. We have at least some baseline of where both of these candidates are on various issues. The problem, as we just kind of spoke about, is that there's so many other factors that might be coming into play this year, especially with, criminal trials going on, these classified documents cases. All of this adds some additional uncertainty that takes place that makes it a little bit harder to kind of frame out how the election may play out, and then what issues are going to be on the top of the agenda for whoever becomes president in 2025.
When you talk about, we know the candidates quite well, do we? Our next guest, or one of our guests coming up later in the show, wrote this in his notes. Rumor going around D.C. is Biden is staying in the 2024 race long enough to win the nomination and pass the buck to another Democrat, TBD Michelle Obama. Do you buy into any of this, that there's basically going to be just sort of a quick switch at the end, and we aren't going to necessarily have a clear sense of who that nominee is going to be?
So I think Biden has actually been pretty clear about this. He is in the race because Trump is in the race. Now, if Trump were not to be in the race, perhaps there might be some movement to change at the convention. But again, that's a very low probability. And then you have to figure out who's going to be next in line. I mean, obviously, I think people would think that it should go to Vice President Harris. And if you were to try to put someone else in there over her, there would be a civil war within the Democratic Party. And that's not really something that you want ahead of the general election. So I think that that's quite unlikely. I think that he's been clear that he is running because he thinks that he is the candidate who can beat Trump. And I also think that Michelle Obama is probably not quite interested in getting back into politics at this moment.
Let's talk about policy. Less on politics if we can. There are some bills potentially going through Congress. Let's talk about the bipartisan tax bill, one, and how likely is it that we'll pass an aid bill without anything on border security anytime soon?
Yeah, so the Senate is now moving on to this national security bill. This is a $95 billion bill. They're going to work through the weekend, maybe even to next week, to try to get this done. Now, it does have some hurdles, even if it gets past the Senate, as to whether or not it's going to move forward in the House. But this is something that is quite important to a number of members of Congress. They do want to provide one more aid package to Ukraine ahead of the presidential election. There's also this tax bill that you just mentioned that's also going through. This passed the House on a very strong bipartisan basis. There are a lot of members in the Senate who also want to pass it despite the call for changes. We do think that that is something that also can get done. And what's something that we're quite focused on is the fiscal impact that these pieces of legislation could have. So we think it's not quite priced in that either of these bills could probably pass. If they do pass, as well as if we actually do get Congress to pass a fiscal 24 budget that is along the lines of what we had with the debt ceiling agreement last spring, that actually could be us seeing more than $300 billion of fiscal stimulus coming into the economy this fiscal year. And that's something that we don't think is quite priced in the markets. It's not priced into debt forecasts, and it's not quite priced into GDP forecasts either.
How stimulative do you and the team expect that to be?
So, I mean, I think that one of the things that we're always looking at is that presidents try to boost the fiscal stimulus ahead of the election. And Biden is not going to be any different than past presidents in that regard. So I think the tax pieces can be quite helpful. The tax bill is, while the headline is that it's a $78 billion bill, that's looking at the 10-year score for that bill. But if you actually look at what's going to be coming out this year, we're looking at $135 billion of tax credits that could be beneficial to companies with R&D expenses and CapEx expenses. So that can be quite helpful for those companies. In addition, you get some benefit from having an expanded child tax credit that could be helpful to voters in this election. And I think also if we do actually get the budget passed, you have defense spending going up. And that would also be something that would be good for those stocks. So the stimulative effect, I think, is at least enough to, probably about 0.5% of GDP, but that's something that can still be helpful as you're trying to support the economy, make sure that there's not a downturn, and then also it could be helpful in the general election if that's something that Biden's looking to try to do.
Do you think we're ever going to be talking about fiscal austerity anytime soon?
So this is something that we've been highlighting quite a bit. So we are, obviously with the Fed having raised interest rates, we have seen U.S. net interest costs rising exceedingly high. We are now over 16% of tax revenues. Usually historically we look back, once you hit 14% of tax revenues, the U.S. does go into fiscal austerity. We're in an election year, so it's not likely that we're going to see fiscal austerity this year. But as we look ahead into the next couple of years, as Congress needs to think about whether or not they're going to be extending the 2017 tax cuts, as they're looking at what they're going to be doing with a new presidency, that overhang of how much debt we have and how much we're paying for interest costs is going to be quite important. And we're going to have to start thinking about how do we do some fiscal austerity if we're not seeing strong economic growth to balance it out.
Jeanette, appreciate the update. As always, enjoy the weekend. Jeanette Lowe there, a strategist. If only you could have seen Bramo's face when I asked that last question. Fiscal austerity?
Look, it's
what
good.
Fiscal austerity?
Okay, it's a good question, but how many years have we been talking about this? Are we going to get fiscal austerity? Well, sometime in the future we're going to have to in order to get the budget into balance, and then it never comes because it's always an election year and nobody wants to accept some of the cuts to certain programs.
Brutal line in Politico just moments ago. A day Biden world wishes it could forget. Yesterday, just brutal.
Yeah, well, and that's probably very true. It just solidifies some of the other impressions that people had, how this is going to play out. We've got, how many more months of this? 9 more months of this? Yeah, so stay tuned.
You were fed up earlier this week.
I haven't really stopped.
I can't wait to see where you're at in 9 months' time. Coming up on this program, Deborah Aitken of Bloomberg Intelligence on luxuries and Big B, and we'll get a recap of Pepsi as well. Equity futures on the S&P positive by 0.1% from New York. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Three days of minor gains on the S&P 500. Equity futures look like this morning. Looking to make it day 4, positive 0.1% on the S&P, and the Nasdaq 100 up by 0.2%, heading towards 5 weeks of gains on the S&P 500. Decent week, even with the bond market selling off a touch, yields higher through the week, really the bulk of that coming on Monday. I'll get to the bond market in just a moment. Let's talk about earnings. The big one 2 Wednesdays away when we get numbers from Nvidia. Pepsi out, Lisa, a little bit earlier. The stock is down by more than 2%.
Basically, it missed when it came to revenue, even though it beat on profit. And we can go into all the numbers, but what I find more interesting is that Pepsi raised its dividend by 7% and said it would buy back about $1 billion worth of shares. Why I find this interesting is because yesterday I was reading some data that so far in February, there has been the greatest amount of share buybacks announced by U.S. companies ever in history for a February. And it's been one of the best starts to a year after 2023 ever. So this in terms of share buybacks announced. This raises a question, is this because managements are comfortable because they see a better opportunity forward? Is this because they don't know what else to do with their cash and they don't know where to invest it? And how much is this really what's kind of behind some of the support that we've gotten in markets? I find this really interesting.
I want to talk about pricing power as well for some of these consumer-facing companies. That stock is down by about 2.3%. I want to talk about that because really I just want to talk about this from Michael Hartnett over at Bank of America this morning. You've seen this, haven't you?
Yes.
This is amazing. 30-second ad during Super Bowl I, 1967, was $37,500. The price for the Super Bowl this weekend, $7 million. He says that's a 185 times jump. Says nothing keeps pace with the Super Bowl inflation, but if they could, a 6-pack of beer would be $340. A gallon of gasoline would be $61. The average U.S. house price would be $4.2 million, and the S&P 500, never mind 5K, would be at $16,374. There you go. Super Bowl inflation.
You know what this tells me? Michael Hartnett, we feel your pain. It has been a market meandering with not a lot to talk about, with flows not coming up with direction. Congratulations on finding a great angle.
Yesterday, the trading range was so tight. I think we said earlier in the program, it was as if this market wasn't even open. We've had some price action in the bond market, so let's turn to it. 2-year, 10-year, 30-year looks a little something like this. On a 10-year right now, not even up by a basis point, 415.79. On a 30-year, where we had a decent auction yesterday, up just a single basis point, 435.98. More on that later. I want to turn to foreign exchange. Less about the euro, more about the yen. We heard from Governor Ueda, who's got this to say. Even if we end minus rates, the accommodative financial conditions will likely continue. Lisa, dollar yen 149.37.
This is the reason why it's been such a hard thing to trade, because essentially it's just completely predicated on the what if that people have been talking about for so long. And even though you got a couple of weeks ago the suggestion that they were ready to start moving to a 0%, all the way up to a 0% rate, there still is sort of this pushback. We don't need to because we're not seeing the incredible inflation that they were kind of hoping for.
That currency pair totally unchanged this morning. Under surveillance, here are your top stories. Number one, overnight, President Biden failing to ease concerns over his memory and fitness for the job. Speaking last night from the White House, Biden insisted a special counsel report on his handling of classified documents and mental state was inaccurate. After heated exchanges, Biden making another gaffe, referring to the president of Egypt, al-Sisi, as the president of Mexico. Lisa, we all forget stuff. We all get things wrong.
What?
Well, I'll do plenty on this show this morning, no doubt about it. But when you have to hold a news conference to try and make the point there's nothing wrong with your memory, and then you make another gaffe like the one you've already made several times over the last couple of weeks, it doesn't help, does it?
This is not great. Let's just put it that way. And the fact that we were talking with Jeanette Lowe and that there is some speculation that maybe Biden could hand off to another person, and she said it's not going to happen. And we hear that from every strategist. It's not going to happen. So then what is the end game for this? If he thinks he's the only person that could beat Trump, and then Jim McKelvey came on and said essentially, Trump would lose against anyone but Biden, and Biden would lose against anyone but Trump, or that they're sort of, equally sort of not loved candidates. Why are we doing this again?
His handlers, I do wonder how this is going to work on this campaign. You go back to the previous campaign of 2020, we're in the pandemic. They joked that he was in the basement, but ultimately he wanted to make it a referendum on the sitting president, and he was successful doing so. He didn't have to campaign in quite the same way. This time around, there is no pandemic. He's expected to get out there. When you make mistakes like this, the spotlight is on him big time. Less forgiving of mistakes for this president than anyone else, given his age.
I'm glad that you switched the conversation to policy earlier, because you're talking about the bill that has to get passed. You're talking about that he's going to be meeting with Olaf Scholz later today, and the fact of sort of how are you going to deal with not what his name is and who he is, but in terms of what kind of aid gets to Ukraine, how we deal with some really intense geopolitical things. That's where the focus should be, and the fact that it's not is really a shame.
The focus elsewhere yesterday as well, the focus on Russia. Russian President Vladimir Putin saying he has not achieved his objectives in Ukraine yet. Putin telling former Fox News host Tucker Carlson he would be open to negotiations if the US were to stop sending weapons to Ukraine. The Russian president also discussing jailed US journalist Evan Gershkovich of the Wall Street Journal, saying he believes an agreement could be reached to secure his release. So we talked about this a little bit earlier this week, and we said you can't cover this particular interview without pointing out that many people have asked for an interview with Vladimir Putin and have not been given one. And many people have tried to cover this war and have been locked up in Russia for it. I will say this, though. Credit to Tucker Carlson for taking on the Russian President Vladimir Putin at the end of that conversation in quite the way he did to try and push for the release of this journalist.
Yeah, that I agree with. However, he then said, sure, we just need to have some sort of negotiation at some point in the future. Again, theater. I mean, that's sort of my take on this. He did push for the release of Evan Gershkovich, and everyone is hoping that he comes back. The question is, what is the president of Russia going to demand in response?
And the aid that we're set to provide here in the United States to places like Ukraine, the fatigue is real. It's real in this country. It's real in other countries too.
Well, and he said that, right? Putin was like, well, as soon as the U.S. stops providing weapons to Ukraine, we can negotiate something in a couple weeks. Okay, what are those terms of the negotiation? Them ruling over Ukraine? A lot of things need to be developed, and the point that people can't talk with a unified voice is really becoming a problem in terms of Ukraine that's complaining that they don't have enough missiles.
That's the latest on Russia. Let's get to the latest on the earnings. Lisa went through PepsiCo. I want to talk about Immerse hitting a fresh all-time high after beating sales expectations. The maker of Birkin bags defying fears of a broader slowdown in luxury goods. On the opposite end, L'Oreal reporting disappointing results, citing a slowdown in shopping by Chinese travelers. Also this week, Kering warning its Gucci label is suffering from a slowdown in sales, but the company's CEO vowing to revitalize the brand. Gucci's been in a tough spot for a while, Lisa, but I think you look at Hermes this morning up 5%. You get the feeling that that's a stock-specific story and not any indication of what's happening with the broader luxury market at the moment.
Yeah, although I take your point about buy now, pay later. I take your point about sort of, what else do we have to lose? Doom spending, this whole idea of let's just go and buy something beautiful and go on a great experience because we can't afford to buy a house. I mean, this sort of idea maybe is losing some steam as people face reality. And maybe that's part of what's behind it, because I thought it was interesting that a firm, the buy now, pay later firm, came out with disappointing forecasts for this year, seeing some sort of slowdown in that. So I don't know how much that's behind it, and it's sort of who you're catering to versus nice silk scarves and Birkin bags.
Well, we can get to that in a moment, but buy now, pay later, that exploded over the Thanksgiving holiday. Remember, Black Friday into Christmas shopping. You wonder how things are trending coming into 2024. My line of the morning, though, comes from Deborah Aiken. She says this about Hermes. It's in a high luxury league of its own, delivering by far the highest quality among luxury peers. Deborah Aiken, I'm pleased to say, joins us now. Deborah, do you think this is a stock-specific story rather than an industry story when you look at these numbers this morning?
Hi, I do, in one way, and it always has been the case for Hermes. The growth rate, the 21% growth rate on the back of a year ago growth rate that it achieved, the way that it's building its earnings numbers, the way that it's focusing on that growth with new production facilities and staff, it's untouched. And we see that carrying on. And the biggest risk to Hermes is that it becomes a little bit diluted over the longer term, but for the midterm, we see that continuing. But there are companies now, what I thought this may come up. So there are some companies, if we look from the beginning of the year and the share price performances, we have anywhere from 10 to 20% share price performance positive from the LVMHs up to the Tapestries. Which is the owner of Coach, which we saw yesterday delivered very well. So, and it's the US, you know, so we look at what's happening, doing very, very well in the US, and that is counterbalancing what's happening still at the moment in China.
Deborah, you've touched on it, just how polarized this luxury market is at the moment. Can we just talk about pricing power? I saw a line from the executive chairman, Axel Dumas, who said that we could have price hikes of 8 to 9% on average in 2024. Who else has that pricing power?
He said that, but he won't do that. We saw that certainly over the last couple of years, though. It had to be passed through. And those at the top end were passing that through successfully, and those shoppers out there were accepting it. So there were many over the last couple of years who had that pricing power, but now we start out with average share prices across the board in many luxury categories and across many brands, 20 to 25% higher. So that really means that you need innovation, new labels, collaborations and others further down and below Hermes. That doesn't say, though, that they don't pass pricing through of 2 to 4% this year. That would be where I would expect pricing to go.
Deborah, is there any macro trend that we can take from this? That companies that are less exposed to China or that are more exposed to a higher end kind of consumer are doing better? Is there anything at all? Or is this just silk scarves and Birkin bags that people like?
No, I think, and for Hermes, it really is about exclusivity. So we stand that aside. And it really is delivering every sector, every region, and it's quite similar in terms of the growth rates and the trends there. But if I set Hermes aside, if we look at other companies, I would say actually that the US is particularly robust, and it's been better for most companies than we ever thought going into this earnings season across beauty, high end, and the high end of luxury. And we see that also, even with the L'Oreal number today, where they have the US up 12%, despite a flat China market where L'Oreal outperformed with about 6%. So Europe as well. Europe is resilient against Europe being quite strong last year and advancing on the back of tourism. It's doing well too. So there's a lot going on brand by brand that you mentioned at the very beginning. There are some brands such as Gucci, such as Salvatore Ferragamo and Burberry, where they're amid strategy overhaul, and that's about really getting the brand perception into the mind of the consumer as really being elevated from where it struggled previously. That's still an ongoing thing.
Deborah, Lisa talked about buy now, pay later. If I can just jump in and get a response from you on that. It felt like that for a while that was being used for the entry-level luxury items, maybe as, say, a Gucci. Deborah, you seen that change, those trends change over the last 12 months?
Yes, I think in the US in particular, on the back of the voucher system and others from the year prior, we saw the US at the entry level aspirational, particularly with the fashion brands, probably trained down from about September 22. And what we've seen through the second half of this year against those easing comps the end of last year, but we've seen that has kind of evolved a year ago, and so we're actually coming out of that and we're seeing a more robust performance at entry level, and that is actually surprising for some brands. But the brands need to be really astute. They need to be in the face of the consumer. The consumer, even at the entry level, needs to feel it's personalized marketing. And you talked about marketing at the beginning of this too, and advertising spend and how we use the cash flow. L'Oreal is an absolute amazing example of this. It's taken its marketing spend from 12 to 13.3 billion this year, 32% plus of sales. And what it talks about is tech for the future. And that's how outside of Asia, it's just growing the business so profoundly well, probably 1.4 times the market rate for that company.
Interesting.
So, yeah, it's so mixed, but there are so many interesting messages out there.
Deborah, pleased to get some clarity from you. Appreciate it. Deborah Aiken there of Bloomberg Intelligence on Immerse. Her line this morning, high luxury league of its own. Bernstein, strong brand momentum. Morgan Stanley, results very solid. The stock looking pretty decent, up 4 or 5% over in Paris, France this morning. Let's give you an update on stories elsewhere today. Here's your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden has criticized the extent of Israel's military campaign in Gaza. Biden saying, quote, there are lots of innocent people who are starving, a lot of innocent people who are in trouble and dying, and it has got to stop. His comments came after Israeli Prime Minister Benjamin Netanyahu previewed plans for ground forces to enter the city of Rafah. Rafah lies to the south of Gaza and near the Palestinian territory's border with Egypt. Pepsi's shares are lower in the pre-market trade after its outlook for revenue fell short of estimates for this year. Pepsi saw profit growth for the year. Still, it saw that, citing customers' appetite for snacks returning to pre-pandemic patterns. Shares of Pinterest are also falling in the pre-market session. The company reported weaker than expected fourth quarter holiday sales. Revenue came in at $981 million. The estimate was $990 million. Earlier in the week, Snap plunged after posting similar misses. Still, analysts are positive on Pinterest thanks to a new ad partnership with Google. That's your Bloomberg brief. John.
Hey, Danny, thank you. I miss a lot of things about TK. Number one this morning would have been his review of Pinterest.
I think so.
Every single time.
Oh my God, unbelievable. What do they do? I don't get it. I went on there for a hot second and it was terrible. It's more geared toward women, yes, and typically it is just sweshed around sales. But, you know.
You see, you say that, it sounds okay. When TK would sit here and say it skews female.
Well, but it's true.
Like, yeah,
if you look at the actual numbers, it actually is true.
It's wedding lists and stuff like that.
Well, and, you know, if you want to renovate your bedroom or your kid's bedroom, then people go on this. I've gone a little bit and I haven't been able to keep my interest just because I'm not very good at these things. But I will just say this. The fact that Pinterest and Snap both declining in ad revenue and Meta crushing it.
Own world.
Right. So is it just a consolidation of market share? I mean, can you really say targeted ads from Google are really going to change the dial for Pinterest?
As the big get bigger and everyone else just gets punished, seems to be the story of the last couple of weeks or so. Up next on this program, the last mile to 2% inflation.
To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. If I could get these kind of numbers sustained, and even better broadened. That's what I'm looking for, sustained and broadening.
That conversation continues up next, live from New York City. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
they'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg, context changes everything.
Live from New York City, stocks just about positive on the S&P 500, up here by 0.1%. Yields higher by almost a basis point. The 10-year 416.37. Under surveillance this morning, the last mile to 2% inflation.
It's a very strong labor market still, and so gratified to see inflation coming down, hoping it continues to come down, and I think we've got some time to be patient. To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
So here's the latest. The Fed tempering expectations for rate cuts until they're confident inflation is heading back to target. At 8:30 a.m. this morning, we'll get revisions to last month's CPI data. January's print due out on Tuesday. Henrietta Parkman of Allspring with a warning right in this. We are seeing slowing growth and we are fighting the tougher last inflation innings. We have moved from a world of constrained demand to more vulnerable supply chains. Henrietta, I'm pleased to say, joins us now for more. Let's just begin, if we can, with the growth outlook, because what we've seen so far here stateside is upside surprise after upside surprise. What kind of slowing are you anticipating?
Well, it should, right? And it is true that the US has really defied gravity over the course of 2023. And to be fair, it is true at the beginning of 2024, some of the numbers that were coming out, particularly in the labor market, are stronger than expected. That being said, a lot has been thrown at the situation in terms of rate hikes, and that does take variable lags to sort of come into the economy. So it should slow. We'll have to see if it does. The positive side is that we are seeing inflation coming down.
As you know, there is a concern, though, for some central bankers that inflation stabilizes above target. Do you share those worries?
I think it's a very fair question, right? As you mentioned, we are in the last innings. It is the hardest part. We're looking at the services. We're looking at some of the inflation that might be wage-driven as well. So it is the tougher part. So it really explains why the central banks are being cautious about going too soon in terms of their rate cuts at this point.
You know who's not being cautious? Everyone in bond markets, where they're basically going into as much risk as possible and people are bidding up bonds, even as the U.S. sells record amounts of them. You were pointing out, you understand why, because there is something for everyone. If you want spread, if you want duration, you can go and you can find it because you're actually getting yield. How long will that look attractive if we still do see some of these economic prints coming on hotter than expected?
At the moment, you're in a situation where there's a lot of cash. You showed some of the statistics earlier today, and it's true. There's a lot of cash sitting on the sidelines, and that means that there's powder dry for investors moving into other asset classes, and that includes the bond market. I think that we'll see more of that this year. It's been really interesting to see the issuance patterns that you mentioned in treasuries. Pretty big issuance, and that's been very well absorbed over the course of this year. Again, if you look at the European markets and actually IG, you've had some record sort of inflows into the asset class. So I think there is appetite for the fixed income piece of the market. And it's not just a growth story. It is also that inflation story. We have seen inflation coming down, and that's what investors are looking at. Another aspect that I think investors are taking comfort from is that we are talking about rate cuts. It's a question of when.
So where is this cash coming from? Because when we hear from people, they say there's $6 trillion in money markets. And then we talk to someone who runs money market funds and said it's not moving, it's just growing because this is actually an asset class in its own right. Where is it coming from?
Well, it's interesting. It's feeding on itself. Some of that, you've got a decent coupon on the cash side of things, and I think that is helping. We had an interesting conversation with an investor the other day, saying that actually something that might be slowing the economy is to cut rates, because it'll mean that you get less income on the cash side. So I think it's a question of investors being cautious, wondering what's going to be next from an equity perspective, maybe not quite being ready to fully go into the bond markets either, and I think that explains what we're seeing in the cash markets.
I love what you just said there, because it's so counterintuitive, but it's something that people flirt with sort of in back rooms and not necessarily in public, where they say, what if higher yields are actually stimulative and lead to more inflation because people are earning income that they can then put back into markets and put back into the economy? Do you buy into that? Is that sort of more true than people realize?
I think it's something to bear in mind, and given the sort of levels of yields that you've got, across the US and across Europe, actually, in the cash market, something you haven't had in a while at this point.
Great to catch up and get your thoughts, Henrietta. Thanks for joining us this morning. Henrietta Packerman there of Allspring on what we're seeing in the bond market. So let's talk about what we've seen so far this week. In fact, let's wrap up the year so far. Tons of issuance, corporate credit, and not just investment grade, lots of supply, and it's been taken down really quite well. The demand has met that supply. This week we had a lot of supply as well on the sovereign side of things. We talked about the 10-year slate, $42 billion of 10-year notes rather, from the Treasury. That went pretty well. Following day, 2 days later, 30-year bond, $25 billion worth, also taken down quite well. Year to date, that supply, Lisa, has been met with pretty solid demand.
That's the unusual part of this, is that you've had a near record supply in a lot of different asset classes, and you've had the demand meet for it, and a lot of people saying there's cash on the sidelines. I just wonder where it's coming from. Because if people are satisfied locking in yields of, say, 4% on a 10-year Treasury, that indicates they think that yields are going to be lower than that over a longer term. And if you start to get nervous that inflation is stickier or the deficit will matter someday, then suddenly you start to have a different equation. Likewise, for some of these corporations, there is an expectation that they can keep rolling it over and be kept afloat by private credit until rates are going to go lower. It just hasn't really been fully assessed in markets that this is the new rate, because nobody believes that it is.
High yield spreads, 321. 321 at the close yesterday. We're getting tighter and tighter. We've talked about this over the last week. There seemed to be a shift in central banking. They've been constrained by above target inflation for the last 18 months or so. I think there was a worry in markets about their ability to respond to negative shocks. Then we got some evidence of that maybe 12 months ago. Big worry in the market. We got through it. Now I think there's a lot more comfort about the ability of the Federal Reserve and this chairman to respond to a negative shock if we get one, because of the improvement we've seen in CPI. And he basically told us that last week in the news conference.
If the big threat is no longer inflation, they have the tools to cut rates much more dramatically than they have for decades in order to respond to weakness. Companies also have greater resilience because of their pockets of cash, if you believe that inflation is going to come down. And that, I think, is the change. You've seen the credit quality go up in a lot of these corporations. And so that's what people point to as a reason why you can see such an incredible rally.
That caveat's important though, right? If you believe.
Right, well, I mean, that's exactly why that is the big headwind. It is the potential for reinflation in the economy.
This conversation continues. The brilliant Jay Pilosky of TPW Advisory, and since people get jealous, I'll continue. The brilliant Greg Valliere of AGF Investments, the brilliant Jennifer Bartashas of Bloomberg Intelligence, and the brilliant Earl Davis of BMO Global Asset Management in the second hour of Bloomberg Surveillance.
It's gonna be a thing.
A brilliant hour coming up next. People get so sour when you call one brilliant and the other's not. Do you notice that? You're brilliant too.
I don't need it.
Marie's brilliant.
Everyone's
TK's brilliant.
Everyone's
part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
What I'm focusing on is the productivity boom. That is what's driving this immaculate disinflation we're seeing.
I can't make the case for a whole lot of upside other than momentum, which is very powerful.
The data is telling me to be risk on.
I think there's a lot of opportunities in the U.S.
We're actually seeing some signs of a re-acceleration in economic activity.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500. Not doing much at all. And I have to say, not doing much at all week. It's been pretty calm, drama-free, even with some stellar economic data pushing yields higher at the start of the week, even with one bank, NYCB, down about a third, lost a third of its market cap again this week, Bramo. Things are pretty calm.
I would say it's calm on the surface, but underneath it's a battle. It's a battle
Drama,
between
chaos.
Complete chaos, FOMO versus fear, battling against one another as people try to understand what they should pay attention to more, momentum or concerns about overvaluation and the potential for a whole host of disappointments. And those two things are locked in a steady battle under this relatively calm surface.
What did Julian Emmanuel of Evercore say? Fear meets FOMO.
Yeah. Well,
What's new about that? What's the new thing to fear?
Well, there's lots of things to fear. I could tick them off. I mean, basically, high valuations are one thing that people point to. Narrow leadership is another thing. The idea that people have priced in too many rate cuts and what happens if that doesn't happen. Re-accelerating inflation, given how good some of the prints are. The fact of geopolitical conflict potentially disrupting commodity prices and shipments. I mean, I could go on, but this is my, day trade. But I'm just, people are sort of putting that across.
It's very on brand. I love that you've got the list ready to go. Let's go through a few of them. There is a worry that the narrow leadership is getting even narrower.
Oh, yeah.
You're starting to see some fragmentation in the Mag 7. I'm looking forward to catching up with Jay Pawlowski of TPW about that in just a moment. NVIDIA, in about 2 weeks' time, 2 Wednesdays' time, is the final Mag 7 stock that's going to deliver earnings.
Yeah, although yesterday we did get earnings from ARM, right? And they actually did perform better than expected, saying that the AI trend is very real. So if that's any indication, there is a real secular trend here that could keep bolstering these stocks, which is the reason why people haven't been able to dismiss them. There's something real here. It's not just all fake, fluffery.
It's true. The earnings power has been absolutely phenomenal. Take Meta. Meta up $200 billion a week ago today. in market cap in a single session, which is still, I'm just sitting here still thinking that is absolutely phenomenal. The big are getting bigger. The problems are elsewhere. Snap, Pinterest, you said it in a previous hour.
Basically, the big are getting bigger. They're consolidating revenue. They're consolidating market share. So don't you want to buy them? I mean, on one hand, you could say this isn't fair. This isn't good for small businesses, blah,
Sure.
blah, blah. But whatever the case may be, they're delivering the earnings. They're delivering the dividends. They're delivering share buybacks. And so at that point, that's really what people are looking at. And they're saying, we can't discount that.
Important to recognize the United States is not the only game in town. There's one stock reporting a little bit earlier this morning, Immerse. That stock is up by, let's call it 5% over in French trading at the moment. It's up 14% year to date. It's having a decent year so far. They're not the only one. There are some names beyond big US tech which are delivering gains so far this year.
The granolas over in Europe, right? This is what people are talking about, the sort of Novo Nordisk and the Hermes and the LVMH. And here's the sort of, question. Can they really compete in some sort of mega trend in the same kind of way that artificial intelligence can in the US?
Sure. I mean, it's very different. Handbags versus AI. It's a completely different world.
Is it though?
I mean, yeah, it is. I think another change, Bramo, that's caught my eye, caught yours too. You start the year, there's a worry that we've priced in too much easing from the Federal Reserve. The Federal Reserve comes out and says, basically, and obviously they've not said this, these are my words, you've priced in too much easing. Their words are reinforced by the data. We have to readjust, yields are higher at the front end, and equities are okay. So it goes back to Stuart Kaiser's world over at Citi. So far, good news has been good news. Spreads are still tight on credit. Equity markets are at all-time highs, even as we have reevaluated and recalibrated expectations around the Federal Reserve.
You still are baking in 1 percentage point cut, more than a 1 percentage point rate cut by the Federal Reserve by the end of this year. So basically, at least 4 rate cuts. So if you start to price in 2, like the Fed is saying, then you get a different response in equities. What's the threshold? And by the way, isn't this one of the reasons why the Russell 2000's underperformed, why some of the smaller, more leveraged companies have really struggled? So until you get a sense of what certainty you have there, can you get that broadening out that so many people are hoping for?
You see this 4 minutes into the show, 4 minutes into the hour, and not a single mention of being old, frail, and having a poor memory.
Well, speaking
of
which, someone just wrote in, fluffery is not a word. Nice try, TK.
Is that what they just said to you?
Which
is
great.
Just said?
I mean, it's kind of true, but fluffery, I think, should be a word.
Bramo, you can make it whatever words you like, okay?
Thanks.
The equity market on the S&P 500 looks like this. Equity futures positive by 0.16%. That's a session high. We talked about it a few times in the last 60 minutes already. It's as if the market wasn't even open yesterday. Just a ridiculously tight trading range. Let's see if we break out of that range a little bit later on today. In the bond market, yields higher by a single basis point, 416.57. The euro a touch weaker, the dollar a touch stronger, 107.72 on the euro against the dollar. Coming up this hour, Jake Pawlowski of TPW Advisory on the record run in equities, Greg Valliere of AGF Investments reacting to Biden's latest gaffe, and Jennifer Bartashes of Bloomberg Intelligence on snack sales ahead of the Super Bowl weekend. We begin with the big story. Stocks looking to make it 5 straight weeks of gains. TPW's Jake Pawlowski highlighting his concerns, writing, quote, the 4-for-4 lineup seen last fall, favourable seasonality, sentiment, positioning and technicals have all reversed for the most part, leaving us cautious on US equities in the near term and looking elsewhere for action. Jay joins us now. Jay, before we get into the elsewhere, because I want to talk about China and Europe with you, I definitely do, and Japan as well. Let's just focus on the US. What isn't there to like when this group of US tech stocks keep delivering the earnings they're delivering?
Oh, no, John, I mean, we're constructive. It's just that we've had a big run, and it's important to realize that the factors that were really attractive to us back in November when we were constructive, unlike most, have now reversed, and that's just reality. And so we want to live in reality. In terms of the U.S., I mean, I think the issue is a failure of imagination, a collective failure on Wall Street of imagination. And I'll give you 2 examples. The first is the consensus for GDP growth this year is about 1.4%. Even though we're basically what the Atlanta Fed nowcast for Q1 is at 4%. And then second, and even more telling, is that the consensus for year-end S&P is 2% below where we are today. And so I think it's time that we kind of expand our horizons, broaden our focus, and think not just about a good 2024, but a multi-year period of a good environment, of macro stability, of rising productivity, of decent GDP growth and good earnings growth. And that's really the focus. And so what we tried to do with that comment was to kind of tell people, hey, the real fat pitch, I know it's football season, but the real fat pitch was in November in the U.S. Right now, it's okay. It deserves a rest. It's going to take a rest at some point. It's going to pull back a little bit. The question is, what do you do then? You should be a buyer. We're very constructive on AI and tech. Completely disagree with the idea that we're approaching a 1999 moment. As Lisa and you were just chatting about, these tech companies today are cash-making machines. Unlike in 99 when it was pets.com, which was absolutely nothing but pets.com. And so we're in a very, very different environment on the tech side. And we're looking now for opportunities elsewhere where the rest of the world is kind of catching up. The U.S. has been the clear leader coming out of COVID, the global growth leader, stock market leader, led by tech, but it's pulling everything else up.
But Jay, hold on a second, because you're talking about pulling everything else up. So weight loss medication and luxury, is that pulling that up? I mean, we're talking about granolas over in Europe as something that people are trying to lean into, which includes Novo Nordisk and LVMH and a whole host of others, including Hermes we just got today. Do you buy that is a similar type of trend as artificial intelligence that people say is transformative?
Well, you know, it's funny you say that, Lisa, because there's the Magnificent Seven in the U.S., and we're actually looking right now and adding right now to what we're calling the Magnificent Six, us and a few others. And it's not just Europe, it's IFA, and it includes many of the companies you just mentioned, LVMH, Novo Nordisk, AstraZeneca, but it also includes ASML, which is critical to the expansion of the semiconductor industry, and SAP, the German software company. So there is technology in Europe. And what's interesting is there's technology even in emerging markets. I was looking just the other day, and the #1 sector in the broad EM index is technology at 20%. And guess what? The broad emerging market index just broke out and above its 200-day resistance level. So ACWI is hitting a new all-time high, global equities. So yes, it is a broad move. It's led by the U.S., but ACWI, global equities, are hitting new highs. Emerging markets breaking above their 200-day average, which includes a 25% weighting in China. If you look at EMX China, it looks very much like the U.S. in terms of the chart.
Jay, I know we're friends, but we're being way too kind by just focusing on Europe. You mentioned China. Let's go there. The most unloved equity market on the planet right now. You raise your group with this to say. We caught up with Anna Ashton yesterday and the team. A continuation of the current approach to equity market volatility, which includes state buying, administrative controls, financial crackdowns, unlikely to provide more than a few weeks of reprieve. Instead, it entrenches the sense of malaise and weighs on confidence. I know you took a sip of a drink. You know this is coming. Jay, when is this going to change?
Water, John.
What is it going to change?
Well, look, you know what? I think the environment that we saw back in November in the U.S. is now to be found in China. Absolutely rock bottom sentiment. Seasonality typically quite good around the Lunar New Year. Positioning obviously horrible, right? Everyone's puked out China. And technicals are very good. Capitulation, if you want. Some people are calling it capitulation. Others are saying that technicals are extremely compelling for a significant bounce. And I look at things like, and we own China, right? And you know that we've been talking about it for a while. We were quite constructive last fall. It was wrong. It was the worst call we had last year. But we resized it. We shrunk our position and narrowed it down to the tech sector. And I'll just note that KWEB, which is the thing we're playing, the ETF, is well above its lows of last year. So it's about 10–15% above. So it is not, even with all the negativity, it's still above the lows of last fall. Fall of 22, October of 22. So a year and a half now, give or take. So my point is that all the things that were appealing about the U.S., which we talked about at the lead, has now shifted over to China. They worked really well in the U.S., and everybody was very skeptical, and we're up 20% in 3 months.
But
Could
Jay,
China be up 20% in 3 months? Absolutely.
We just have a bit more.
And in the interim, it's not performing. It's a drag on the portfolio, but other things are working, which should give you a willingness to hold something that you think has upside, even if it's not working at the moment. And by the way, it's completely uncorrelated with the U.S., right? U.S. shooting up, China shooting down, completely uncorrelated. At some point, the U.S. will take a rest. China will move. And that's how you run a portfolio that's going to work, over time.
Hold on a second. Bear with me. We just have a little bit of time left. I love that you can tell how much pushback you've gotten and how frustrated you are trying to justify why this is a call that you're going to stick with. I'm just wondering, though, about sort of the logical leap here that China could recover, but that won't cause inflation to reignite in the rest of the world, and that could be problematic to your thesis. How do you deal with that?
Yeah, no, you're right on it, and Lisa, and I'm going to write about that today in our musings, because I think that I'm starting to develop the thought that China kind of being a laggard here is constructive, because if China was firing on all cylinders and the U.S. firing on all cylinders, yeah, you might get some commodity type inflation. And so maybe that we're having a staged, asynchronous recovery globally, which I think we are very much in the early cycle camp, is constructive. And I'll leave you with one thought here that's happening right now as we speak. TLT, long duration treasuries in the U.S., just breaking down below its 200-day support level here in the last few days. GSG, global commodities, breaking above the 200-day resistance level. Yeah. I think the next move will be a weaker dollar, which is going to give support to more of the non-U.S. action as we see this play out a little bit. We're constructive on low inflation, but we're watching this relationship. TLT breaking down, commodities breaking out, dollar will be next. Rest of the world has a chance to catch up a little bit to the U.S. while the U.S. takes a rest.
Jay, we got to go. We weren't expecting such a long monologue on China. I just want, in one word, Super Bowl, Sunday, pick a team.
Oh, my gosh, yeah, going with the 49ers.
Okay, Jay, it's good to hear from you. Jay Pawlowski of TPW Advisory. Jay is the only guy I know who would pick out his losing bet and turn around and say, you're welcome.
Exactly.
It's good news.
Saying that basically, I'm going to tell you why you're going to miss out so big if you're not in this, and that's what we heard.
It's a good job China didn't deliver because XYZ. Let's get you some top stories from elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bankers at Barclays are facing a brutal bonus season. A slowdown in deal-making and capital markets activity is forcing the bank to cut payouts for a larger than usual group of its lowest performers. Executives are also planning to shrink the overall bonus pool. Sources say junior bankers are likely to be spared, and top deal makers may still see an increase of up to 10%. Shares of ARM surged as much as 48% on Thursday. The chip designer posted a blockbuster earnings report boosted by AI. Speaking to Bloomberg, CEO Renee Haas said the company is still in the early stages of AI and is not, quote, in any way, shape, or form hype cycle. ARM's bullish outlook helped send its shares to the biggest daily gain since it IPO'd last December. L'Oreal shares are down after reporting disappointing sales. It was hurt by soft demand in China, with shoppers reining in their travel spending. Shares had been trading near an all-time high prior to the results. Analysts had thought L'Oreal was faring better than its rivals, particularly in China. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, the president taking a defiant tone.
My memory is fine. My memory, take a look at what I've done since I've become president. None of you thought I could pass any of the things I got passed. How'd that happen? I guess I just forgot what was going on.
Live from New York City, that conversation up next. This is Bloomberg.
authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Equities on the S&P 500 going into the opening bout a little bit later this morning. Slightly positive on the S&P by 0.14%. Yields up a single basis point, 416.96 on a 10-year. On a euro, slightly weaker against the dollar. Negative here by not even a tenth of 1%, 107.72. Under surveillance this morning, the president taking a defiant tone.
My memory is fine. My memory, take a look at what I've done since I've become president. None of you thought I could pass any of the things I got passed. How'd that happen? You know, I guess I just forgot what was going on.
In December, you told me that you believe there are many other Democrats who could defeat Donald Trump. So why does it have to be you now? What is your answer to that question?
Because I'm the most qualified person in this country to be president of the United States and finish the job I started.
It's the latest this morning. President Biden defending his mental fitness, pushing back on a special counsel report over his handling of classified documents, which described him as a, quote, sympathetic, well-meaning, elderly man with a poor memory. Concerns about his ability to serve growing ahead of November's election. Greg Valliere of AGF Investments writing this. Democrats we've talked with are increasingly inclined to call for a meeting with Biden, diplomatically suggesting he should step down. But that probably would infuriate him, which has prompted some Democrats to look at the 25th Amendment, which lays out a scenario that would lead to his ouster. Greg, I'm pleased to say, joins us now for more. Greg, let's get into that. The Democrats you've spoken to, senior Democrats, senators, who are these people?
Yeah, there are people on Capitol Hill who are increasingly worried, John, about a loss of the House, Senate, and White House in the next election. They fear that Biden could drag candidates down, and I think that's a legitimate fear.
Greg, is this because they're worried about his mental fitness, or is this because they're worried about the political ramifications around him continuing as the leader of the Democratic Party?
I think it's both. And just yesterday afternoon, when I was starting to feel they were picking on him and maybe it wasn't fair, he got the president of Mexico and the president of Egypt mixed up. This has been an extraordinary week for Biden, with one gaffe after another. And you have to ask the question, is there going to be more? And I think that the answer is yes.
So people are worried about angering him. Is there anyone around him to have an honest conversation about how to build up leaders within the Democratic Party around him so that if something does happen, he can do some sort of handoff?
He's pretty isolated, Lisa. I think, his wife, Kamala Harris, there are people who can talk to him, his son, who can talk to him and say, you've done a great job for almost 4 years. Maybe it's time to retire. But right now, I think that's still a long shot, and that's why the Democrats are increasingly worried about a really tough election.
Greg, what would the selection process even look like if he was to go down that path?
Well, the 25th Amendment, John, to the Constitution stipulates that cabinet members, a majority of cabinet members, must certify that the president has become incapacitated. That's very subjective, obviously. But if a majority of cabinet members said that could lead to his ouster. But I don't think that's remotely imminent.
Greg, the compare and contrast yesterday shouldn't be lost on anyone. The former president was facing a Supreme Court hearing on whether he could even run in the election in 2024. And somehow yesterday ended up being a win for the former president and a loss for the sitting president. Greg, how are we going to frame this going into 2024?
Well, you've got the former president who's bombastic and aggressive and shows pretty good energy. And I think the American voters are dismayed. I travel a lot and talk to people who say, this is our choice. Biden and Trump, and you have to wonder, is there anyone else at this late date? No, I don't think Robert F. Kennedy is a serious threat. You know, maybe if Nikki Haley catches fire, or maybe if she starts thinking about running herself as a third-party candidate, that would be intriguing. But right now, we got Biden against Trump, and that for many Americans is not an appealing scenario.
Greg, is there any historical analog to this moment?
Well, you know, I pointed out in my piece this morning, in 1919, when I was just starting out in this business, Woodrow Wilson had a debilitating stroke. And for the rest of his second term as president, Edith Wilson, his wife, ran the government. I don't think we're in a situation like that now, but, you know, presidents get sick. Ronald Reagan was starting to falter at the end of his second term. But the Woodrow Wilson one was a serious one. He did lose a lot of his mental acuity.
A lot of people are looking to try to understand what the policy prescription is here and how this sort of relates to what gets passed or not down in Washington. I just wonder how some of this drama plays into getting Ukraine and Israel aid passed and some of the other just sort of nuts and bolts of D.C.
With all of this about Biden and Supreme Court hearings, things like that, we got stuff to do. There's things that have to be done. By early March, there are 2 deadlines to keep the government open, and no one's really talked about getting a budget done. But they're going to have to focus on that in the next couple of weeks. And as you suggest, there's aid to Ukraine. I'm a little more optimistic Ukraine will get something, but I don't think they're going to get $50 billion. That price tag is a little too rich.
What number are you expecting, and what underpins that optimism?
Could be 20 or so billion, hard to say, but I do feel that there's a growing anxiety that Ukraine is beginning to falter. And we see a new general appointed yesterday by Zelensky. I think the idea of a faltering Ukraine really unnerves people in Washington. So I do think it may be still months away, but I do think Ukraine will get some aid.
Hey, Greg, appreciate it. Appreciate your opinion this morning. Greg Valliere there of AGF Investments. It's being taken very, very seriously, Lisa, what's taken place in the last 24 hours.
Yeah, with respect to the 25th Amendment, is that what you're talking about? This idea that people are actually talking about what would be required to not just have a hard conversation, but actually take action. That's pretty notable. It's a pretty notable view that
it's amazing, isn't it? You know, you and I have talked about this a few times already this morning. I think it's worth going over once more, that we're not talking about the fact that the former president had a hearing yesterday about whether he could even run for the election this year, and somehow yesterday was a big win for him and a loss for Biden after last night's performance.
Yeah, I think a lot of that, the legal dramas and the legal intrigue around Trump have been really creating just more noise and used as a campaigning tool for him to raise money.
The news conference yesterday evening made this situation even worse.
I know. Again.
And it already was.
Where are the handlers?
Don't know. Equity futures on the S&P, positive 0.1%. Coming up next, Jennifer Bartashis of Bloomberg Intelligence on snack sales ahead of Super Bowl weekend.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock. Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Live from New York City, going into the weekend, a few hours away from the opening bow, 2 hours away. Your equity market on the S&P 500 looks a little something like this, positive by 0.16% on the S&P, on the NASDAQ up by 0.37%. The NASDAQ 100 with a lift. The next big stop for that equity market, the next scheduled stop anyway, is going to be NVIDIA earnings in 2 Wednesdays' time. In the Russell, the small caps positive by 0.4%. In the bond market, we have taken a ton of supply, more than $40 billion of 10-year notes earlier in the week, $25 billion of 30-year bonds yesterday, met with some really resilient demand. Yields are higher on the week, particularly after the data we got on Monday, the ISM services read, really quite strong. The 2-year closing a week very close to 450, up 2 basis points to 447.57. The 10-year also higher by 2 basis points to 417.34. Lisa, 1 hour from now, CPI revisions front and center, particularly after what Governor Wallace said last month. My hope is that revisions confirm the progress we have seen, but good policy is based on data and not on hope.
It shows how messy it's been post-pandemic with some of the data, and that there have been more discrepancies in the gap between some of the reported numbers and the revisions with seasonal adjustments made have been pretty great. And I'm not saying that this is sort of, you know, manufactured numbers and all of the conspiracy theory that some people put out there, and they'll comment to me all the time. It's not that so much as it's harder to get a read when you've got fewer people responding to surveys and you have different types of trends that are muddying some of the picture.
So let's look at what they're doing, spending. Let's look at retail sales. Bank of America put out a note yesterday, share this quote with you. With real income growth picking up due to a strong labor market and continued disinflation, the risks to consumer spending are increasing to the upside. To the upside. Bear in mind, for the likes of B of A, they were looking for a cut in March, pushed it back out to the middle of the year. Barclays too, Goldman as well. So a few of those banks need to push that out because the data has been decent. It's been pretty strong.
And it's been confirmed by a lot of people, seeing revenues potentially coming in stronger than expected. And yes, it's because credit card outstandings have gone up. But the American household is less leveraged than it has been traditionally. And what you're seeing is real wages starting to go up. And so all of a sudden you have to wonder, okay, again, which is gonna go to meet which, right? Are we gonna see services go down to manufacturing or manufacturing go up to services? We're seeing manufacturing excel and you see services staying high, and that's where we're at.
Manufacturing really picking up, and after being really terrible for the best part of 2 years, a year and a half, very close to getting into expansion territory. Want to finish on foreign exchange. The new number we've talked about all week, 105. Jane Foley, Rabobank, 105. SocGens, Kit Jukes, 105. Looking for the euro to drop to 105 from 107.67, primarily because of that conversation we're having, Lisa, about better data in America and a struggle over in Europe.
It's a bold call, 105. Go all
very
the way
close,
down.
aren't we?
It's just basically showing that we're going to meander with the dollar slightly stronger, which seems to be a feeling, at least for now, for a lot of people.
The two things you hate at the moment, politics
just two,
and a euro. Seem to be top two.
Well, no, the euro, I think, is an important story, but it just isn't one that's changing very quickly. And then you have politics, which I guess you could say the same thing about.
107.66. We're negative 0.1%. Under surveillance this morning, President Biden pushing back on concerns over his fitness for the job. A special counsel reporting on his handling of classified documents, noting Biden's, quote, diminished faculties and faulty memory. Biden arranging a last-minute press conference to address the comments, only making things worse with a new gaffe, referring to the president of Egypt as the president of Mexico. Awkward, really awkward. You want to clean this up, you hold a news conference, and then you finish it like that. Not great.
Again, it really raises the question, who's around him? Who's advising him? And then, you know, how much pushback is he going to get from other members of the party? I really keep going back. I keep thinking about what Greg was just talking about there, saying that there are senators and people around him seriously considering the 25th Amendment. I do wonder, though, is his concerns about mental fitness, or is his concerns about political ramification and a greater chance of him losing versus Donald Trump? I can't tell.
The second point is super important. You see how this plays out at the polls. You can tell how Americans feel about this issue of age for this particular president. It's a problem. President Trump, former President Donald Trump, not that much younger, they don't have the same concerns in quite the same way. And I think we've talked about this a few times, and it's always worth repeating. We know plenty of people of a certain age, around 80, who are still really mentally very sharp. Can hold a news conference, deliver it, take questions,
100%.
Bite back, all of the above. It's not just about the age. It's about the performance. It's about the performance under pressure in a news conference like yesterday, and you make the same mistake you've been making all week over the last 2 weeks.
Here's my frustration, is that no one's having the real conversation of why are we not having real other leaders who are younger coming to the fore. And one of the big reasons why is because there are identity crises in both parties. Who is going to really represent the mainstream in parties that are increasingly polarized? So what you get is people going with sort of the standard bearers. And this really is raising a problem because a lot of people are feeling pretty alienated by a race that they don't want. And I think that's really a question. Well, how do you then cultivate a new consensus in each party and just for the nation? And I don't really see how that's happening on either side.
They can't win their primary. Let's take what's happening in the Republican Party right now. Nikki Haley can't win the primary. Look at the head-to-head with Joe Biden. Absolutely crushes Biden on a head-to-head at the national level. Can't win a primary.
Have you heard anybody really question the primary system? No, because this is basically entrenched. So then how do we evolve from here? And I don't want to get on my soapbox, so I'm just going to stop.
Well, you can. I mean, you know,
I know, nobody really wants to hear it. I mean, come on, let's move on.
We will move on to this from Russia. So Russian President Vladimir Putin said the country hasn't achieved its goals in Ukraine yet. In an interview with former Fox News anchor Tucker Carlson, Putin saying, quote, "We're conveying to the US leadership that if they really want to stop military action, they need to stop supplying weapons, saying if they do, then the war will be over in a few weeks." President Biden expected to discuss aid for Ukraine with German Chancellor Olaf Scholz at the White House this afternoon. That's going to be one to watch, Lisa, later today.
Especially because there is this bill that is moving through the Senate to provide $50 billion of aid, although we did just hear from Greg Valliere that he thinks the number is probably going to be closer to $20 billion. But coming at a crucial point, Olaf Scholz, I'm curious how that conversation goes with the money that they've put up for this and what they're asking for Biden that he can actually provide, given some of the disagreements in Congress.
Do you want less politics and to do a little Super Bowl, some sport? Counting down to Super Bowl Sunday. Food and beverage sales expected to rise nearly 13% from a year ago to $8.8 billion. Bloomberg Intelligence saying the jump is partly fueled by demand for snacks, which are expected to climb by nearly 14%. Jennifer Bartasha, senior packaged food and retail analyst, writing, quote, "Consumer spending has been dampened by higher inflation, but the Super Bowl should still spur demand as consumers see the game as a holiday occasion to indulge." Jen joins us now for more. Jen, can we talk about TV audience before we get into food and beverage sales? How big is this going to be this Sunday, and why are we watching? Are we watching for the sport, the commercials, or Taylor Swift?
Yeah, we're expecting that that almost 69 million people are going to be tuning into the game this year. That's 7% higher than most of the estimates going into the game itself. And we attribute a lot of that to Taylor Swift. Because you've got a much broader audience that is being pulled in because of the personal romantic dynamics as well as the halftime show. When people do tune into the game, you know, about 45% of people are actually there to watch the football game. 41% are there for the ads, and about 33% tune in just for the halftime show. So you've got a nice diversity in terms of why people are watching the show and when they're going to be tuning in.
Jennifer, can you give us the straight line from people interested in Taylor Swift to drinking Pepsi?
So when we're looking at this overall, You guys were just talking about politics, and you were talking about war. This has become almost a holiday. People find the Super Bowl to be a reprieve, and so we're seeing just a lot of anticipation, a lot of excitement around the event itself this year. And so there's a lot of snacking occasion, there's a lot of food occasion, and everybody seems to be planning to tune in.
I'm just curious about how some of these food companies are going to be advertising. I was struck by this particular statistic. More than 40% of commercials shown during last year's game featured celebrities. This year is expected to be the same, including Lionel Messi from Michelob Ultra, Jason Sudeikis, and Dan Marino. There are a whole host of others. I've seen Serena Williams about 15 times. How much is that sort of the holy grail at a time where kind of the eyeballs have moved to Instagram, to Twitter, to maybe not there, but some other places as well?
Well, advertising has become a new form of entertainment, is really what it comes down to. And obviously, a lot of companies put a lot of effort into the ads this year. And what we're seeing is that the advertisers are a little bit more diverse this year because they're expecting more female viewers. So we're seeing ads from the first time for companies like L'Oreal or some of the cosmetic companies. So it'll be an interesting mix. But really, it's they're pulling the talent that they think is going to entertain people. And that's really the trend that we're seeing.
Jen, do you think that the food and beverage mix that they actually start to promote is going to change, not just because of the interest from, say, increased female viewership off the back of Taylor Swift, but also because of the push for Ozempic, going into this post-Ozempic world in America? Is what they advertise going to change as well?
Certainly there could be some changes in what they advertise. With regards to snack and food sales, when it comes to something like the Super Bowl, whether you're on a diet or not on a diet, it usually kind of goes out the window a little bit, and most people look at it as an opportunity to sort of splurge. And when we're talking about snack sales, it's just for this week going into the Super Bowl. There could be longer-term trends for sure, but we think that this will be a time when people sort of indulge a little bit in those snacking occasions.
It's treat weekend, apparently. Jennifer, thank you. Appreciate the update. Jennifer Bartashis there of Bloomberg Intelligence. You wonder, Bremer, how this is going to change in the years to come.
Well, I think that that's probably the question and the worry of some of the executives of some of these companies based on recent reporting, right? Wasn't there reports that Novo Nordisk's CEO got anonymous calls? He wouldn't name what they were.
A couple of CEOs from, say, food companies have been calling me. They're scared about it. That's the quote.
Yeah, so I wonder what they're asking. In public, they're saying, we've got other things that people can have. It's not a big problem. And then in private, how bad is it going to be?
They're worried about how quickly they can ramp up production of some of these drugs, particularly companies like Novo Nordisk, because if they can, you already know, demand is through the roof for these drugs.
It's wrap-up demand, and it's also insurance coverage. It's how cheap can you make these drugs? How fewer side effects can you get? All of these types of things. And then, how much does it change people's tastes in a way that not only are they going to eat less, but they're going to crave maybe things that aren't the snacks that people eat.
What did Danone say? That they were going to be okay because people would demand high-protein goods. Did you see that?
Yeah, well, we talked to Coca-Cola in Davos, and the CEO is saying it's not a big deal because we provide a lot of water.
We've got Diet Coke
and Diet Coke,
all of that stuff.
People want that.
Exactly. For breakfast, apparently, as well.
Really? You're going to troll our control room?
That's what I hear.
You gather?
No, I'm told that people actually do that.
He said that was fine. He said he welcomes it.
As the CEO of Coca-Cola, I have no doubt that he thinks that's fine. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden has criticized the extent of Israel's military campaign in Gaza. Biden saying, quote, there are a lot of innocent people who are starving, a lot of innocent people who are in trouble and dying, and it's got to stop. His comments came after Israeli Prime Minister Benjamin Netanyahu previewed plans for ground forces to enter the city of Rafah, which lies to the south of Gaza and near the Palestinian territories border with Egypt. The panel that blew off a Boeing jet during last month's Alaska Air flight showed signs it had moved prior to the accident. That's according to Senator Maria Cantwell, who was briefed on the situation by NTSB. Investigators found marks on the panel indicating it had shifted prior to breaking loose. In a statement, Alaska Air said that there was, quote, no indication of issues with the door plug prior to that flight. Inter Miami star Lionel Messi's failure to take the pitch in last Sunday's friendly football match in Hong Kong has cost organizers more than $7 million. Spectators were left disappointed when the World Cup winner was sidelined by an injury to his abductor muscle. Some had paid more than $600 a ticket, with organizers now offering a 50% refund Messi was fit enough to play in Japan a few days later, adding insult to injury for fans in Hong Kong. That's your Bloomberg Brief. John.
Brutal. Danny, thank you. I'll be even more brutal. Can you imagine paying $600 for an MLS team without Messi? I mean, seriously.
I understand why people were upset. I also think that this
I'd
sort
be
of speaks
furious, not upset.
But would you pay $600 to see one person play?
Someone like that, sure.
You would?
Sure. I mean, let's go back in time. Let's say I give you the opportunity to go back to the late 90s and watch Michael Jordan play for the Bulls.
All right, fine.
Would you pay,
I
would you
agree.
pay up $600 for that?
All right. But it was no abductor muscle, so you have to understand.
It's one of those moments.
Yeah, well, I mean, I feel for them. It's funny, though, that they were particularly insulted that he played in Japan. It's like, really? You can play for them, but not for us? Okay. It's like, oh, we're going to be snubbed
That's
2
where
days
they began
before.
with it?
Yeah,
Like
I think
Japan
so.
was a more important market
100%,
somehow?
Yeah.
Okay.
Which some people say maybe it is.
Interesting. Up next on the programme, concerns over bond supply continuing to ease.
I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in?
And at those auctions, they've been piling in. That conversation up next from New York. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Equities on the S&P 500 positive here by 0.2%, going into the opening bout. A little bit later this morning, equities doing okay. Yields higher by 2 basis points, getting closer to 420 on a 10-year, closer to 450 on a 2-year, 417.54 on a 10-year this morning. Under surveillance, concerns over bond supply continuing to ease.
Between Treasury supply and corporate supply, I'm worried there's simply not enough. I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in?
Here's the latest this morning. Yields holding steady as strong demand for bond auctions this week reduced concerns about oversupply. Earl Davis of BMO remaining constructive, saying this: we will extend duration and long positions on any rate sell-off. We expect yields in 2024 to stay within the yield range of 2023. Earl Davis, I'm pleased to say, is back with us. Earl, let's get into that and start with the supply. That supply has been taken down really well, not just from the sovereign side of things with some big Treasury auctions this week, but also over the last month or so, lots of credit supply, corporate supply coming to market too. What are the forces behind that really durable, quite strong, robust demand?
Well, I wouldn't call it durable. And the reason why I wouldn't call it durable is there's one buyer out there right now, and it's retail. You know, sovereign wealth funds aren't buying, central banks aren't buying, even U.S. banks aren't buying treasuries as much as they were previously. So we have one buyer out there, and that's retail. Very large buyers, still a lot of money on the sidelines. The reason why I wouldn't call it durable, retail is a fickle bunch. The reason why they're buying now is we've had less volatility over the past 3 months and declining yields. Everyone looked at their statements at the end of January and saw that they didn't lose money on fixed income in 2023, which emboldened them further. We don't think it's a bad thing to buy bonds and durations now. We're at +1 versus a max of +3 in regards to overweight. But you have to realize that retail is a fickle bunch. And for example, if we get a surprise CPI number next week, to the high side and you start seeing volatility in the market, you know who's the first to retrench? Retail.
Interesting. So, Earl, this raises the question then. If you question the durability of the demand of the year so far, which part of fixed income do you think is more vulnerable?
Oh, 2 years. 2-year bonds without a doubt. You know, part of what we were saying last year when we think we'll stay within the range of this year is that our favorite tactical trade, and it still is, and it's been treating us extremely well, is short U.S. 2-year treasuries. Why? U.S. 2-year treasuries even now are at 450. The overnight rate's at 525. You sell those bonds, you invest the proceeds in the overnight rate at 525. Positive carry and significant positive carry, as well as, you know what, we've heard people talking about the resiliency of the U.S. economy. We believe in it. We've been talking about that for the past year and past few months. We think that will continue and push out when the possible Fed easing cycle starts.
There are two questions there, Earl. Whether this is just a positioning kind of tactical play where you're just sort of capturing the difference, it's sort of an arbitrage play, versus a true bet that we're going to get higher rates for much longer, and that the market is completely offsides with some of the rate cutting bets. Which is it?
Well, the quote you put up for me from last year, you know, the high of 10-year bonds, for example, was 5%. Right now we're at 417. So the reason we're at +1 duration is in case we do get, there's a lot of things going on in the world geopolitically, and we do think it provides a flight to quality protection. Having said that, the underlying dynamics point to higher yields, you know, so we wouldn't be surprised to see a test of 450 at that level. We go +2 long overweight duration. And then the high of last year was 5%. I don't believe we go above that, but do we go north of 250 or higher than 450? Sorry. Yes, it's a possibility.
How much are you looking at the auctions? We saw the 3 of them this week, and they all came in pretty successfully with yields below where the yields were trading before the sales, and yet they were at record levels. When will they start to demonstrate some sort of investor pushback, or do you expect this to be the new status quo?
Yeah, so the thing, I've been in this market for 30 years. So the thing you realize with auctions, it brings in a selective type of buyer, someone who needs scale and size, hundreds of millions of bonds, if not billions. So those people come in, it's called a liquidity event because they could buy scale. But you know what? The levels right now are higher than all of the auctions this week. And the reason why they are is because those buyers don't come back until the next auction if they need more bonds. Likelihood is they may or may not, and the auction should do all right. But what worries me is where does the market reprice in between the auctions? And that's why we're seeing this kind of, even though we're steady today, you're seeing this drift higher in yields. You know, people are worried about the data, worried about the impact on the start of the easing cycle. So there's a lot of different dynamics here. Understanding the nuances underneath the market is what makes active managers, right? We're off to a fantastic start this year, despite not having huge amounts of risks. It's specially placed risk because of the dynamics that I'm speaking about are very persistent.
Oh, you mentioned the data. Can we talk about the data that's coming out a little bit later this morning? 8:30 Eastern time, we get inflation revisions. Could you frame for us all just how important that might be to you?
Yeah, it's not that big to me, and the reason why it's not that big is on Tuesday we get actually CPI. And the thing I'm looking for in CPI is core, and from our estimation on base effects, core is going to be very, very sticky for the next 4 or 5 months because of where inflation was last year at this time. So that's going to keep pressure on the markets. The other thing I'm looking for is what's sticky in core is services inflation. And a leading indicator of services inflation is wage inflation. They feed upon themselves. So that's what's worrying me from a risk perspective of something being different than what the market's anticipating. So those are the dynamics and things that I'm looking at very closely.
How long do you think we can still see this idea that good news is good news, right? Especially because you are concerned about some of these wage gains. Right now, it does seem to be that case. Is there a threshold at which the concern about reigniting inflation trumps some of the ease of just a robust economy with people spending?
That is a great question. So to answer your first question, I see how long is good news good news? I think it's going to be all of 2024. And the reason why I feel that is just the large fiscal deficit. You know, people have stopped talking about that. What's driving Treasury supply? It's the large deficits. Those are dollars that go from the public to the private, people's pocket. Keeps them employed, keeps income. You're getting the financial wealth effect as well too. So I do think risk assets will be resilient as well, in line with the economy this year, driven by the deficits. To your question, when does inflation come back into the picture and start worrying people? I think that's a big second half of this year story. Or, you know, we're starting to see real income really increase here with the disinflation, at least temporary in my mind, that we've spoken about. What we're also going to see possibly is the increased shipping costs flow through in about, 6 to 9 months. These things have long lags. So the way our team is looking at it is the first half of this year is a story of growth and resiliency and surprise upside, which we're seeing. The second half of the year is a story of inflation reemerging.
What do you think corporate credit looks like in terms of performance in the second half of the year against that backdrop, Earl?
That's another great question. So two aspects of corporate credit. We're pulling back from high yield bonds in corporate credit. The reason why we're doing that is, that maturity wall that people are talking about is coming. It starts this year and it's next year, the following year. That means high yield credit companies or corporations have to roll over, reissue debt. Debt right now is about 200 basis points higher than where it was when they initially put on, which we think will impact defaults. So we could see defaults increasing in high yield. Because of our view of the economy and its mix, and the volatility is probably our highest conviction thing, we like credit, but we're selective on credit. We're looking for episodes where things widen out to go long, similar to our duration strategy. And actually, you know what? We like financials very much. We think the spreads are attractive. They're tighter now, but when they widen up, that's an area where we do go overweight. So that's kind of our overall view on credit. Like IG, constructive, but you have to be selective on the credits that you take, and moving away from high yield, at least now, until spreads widen there.
Oh, this was quite a view. I'd love to continue this conversation in a few weeks' time. Oh, Davis there of BMO Global Asset Management, with a few calls to get into there, Lisa. Two very different halves for 2024.
Yeah, although good news being good news through all of 2024, thanks to fiscal spending and the deficit. But this point of the inflation concern really picking back up in the second half and creating some headwinds. He likes financials. I know that was interesting to you.
Yeah, somewhat contrarian given what's happening in some of the financials, the smaller banks at least, but on the equity side, and we've seen some of the damage done over in Europe on the bond side of things as well.
Yeah, but basically saying when it comes to high quality, you can get there and you can capture some of the income. The tight spread, so this goes again to valuation.
320.
Exactly. People getting concerned. Maybe just everyone's gotten over their skis with their bullishness.
Oh, Davis of BMO, just fantastic. Coming up next hour, Tom Kennedy of JP Morgan, US Air Force veteran David A. Deptula, now of Academy Securities, Dana Peterson of the Conference Board, and Barton Crockett of Rosenblatt Securities from New York City, taking you towards the weekend. Equity futures are positive. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill, is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Every week that passes, the expectation about how much the Fed's going to cut rates gets less.
It's going to take more time for cuts than people would like.
We have a Fed that we've had some walk back of if March is on the table or not, but I think the base case is still their next steps are easing.
We're in the same camp as the Federal Reserve. We need to see more data.
We look at rates and where the Fed is today. The Fed has gotten us to where we need it to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City. Let's get me to the weekend. That's what that felt like, right?
That was so...
From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your equity market positive here by around about 0.1% on the S&P 500. Lisa, heading towards a fifth week of gains.
And frankly, the optimism is just palpable in terms of the economy. Maybe some people raising some wall of worries thing, but I get the feeling people are sick of worrying. I get the feeling that people are sick of being wrong. And so they're saying, yeah,
how personal is this?
Well, no, I actually am really not sick of being, concerned about things, but that's just my nature. But I really have felt that from people, that the wall of worry has proven an inaccurate guide again and again, so people are just dismissing it and going with momentum.
I'm going to sound like a broken record, but I think they're comfortable with this idea that the Fed can now respond to negative shocks, and that when you see a difference in a stock like NYCB, down a third again, lost a third of its market cap again this week, it's been absolutely hammered. We seem to have ring-fenced that, parked it in one corner of the market, and equities have carried on drifting towards fresh all-time highs, and high-yield spreads are at 320, which is kind of amazing.
It's a great point. It only works with them having the ammunition to fight downturns, not an increase in inflation, not an increase in acceleration in the economy. And even though we're getting better than expected economic data, people still have parked the idea that inflation's going to reignite and the Fed's going to have to hike rates again. That is the big sea change, even as we get data that raises questions about just how quickly we'll reach that 2% target.
You've nailed it, as always. What will constrain their ability to respond to a negative shock? Inflation, without a doubt. Why are we comfortable that the stronger than expected data so far this year won't deliver higher inflation in the year to come? Earl Davis, BMO, if you missed it, Go back over that interview. It was about 10 minutes ago. He talked about the second half of this year, those inflation concerns reigniting. That would change the game. That would change the game, but I'm not sure that's the base case for a lot of people right now.
It's absolutely not. You know why? Because everyone believes in transitory again. Everyone believes that a lot of these are year-over-year supply chain normalizations that stem from the pandemic. It has to do with workers coming back into the force, people pointing to immigration actually helping to bring down some of the wage pressures because people are able to come and fill the roles. Honestly, all of these things, yes. The key question is wage gains and wage increases still well above pre-pandemic levels. And so that really is one thing that I want.
You can sense this is weighing on Fed officials. Tom Barkin, Richmond Fed, was just sat here yesterday for about 30 minutes. This line, no one wants inflation to reemerge. The experience of 40 years ago, it still weighs on them. Now, I'm not saying they're like Volcker. They're really not. This is a very, very different FOMC. But I think they don't want history to repeat. They've got the time to wait. At least they think they have. They're going to wait.
And it's wise. I mean, honestly, if you take a look at consumer sentiment, there have been study after study showing that people tend to feel much worse about paying higher rates in the grocery store, even if they're getting higher wages. It doesn't register if you see that your bagel, egg, and cheese costs $8 rather than $4. It makes a big difference for someone's sentiment when they go to work in the morning.
Is this a politics-free hour? Are we going to do that?
It's
it can be if you want to. No, it's not my call. It can be if you want to.
You know, here's the thing. Do people feel that it is important to even pay attention to? And the question of, you know, sort of the different race, the horse race between Biden and the situation with some of the concerns over his age and mental acuity, and then Trump and some of his issues with respect to the court system. All of these things, we really want to get into this. We can ask our next guest how much he cares about this.
He can't wait. He does not want to talk about this at all. Coming up this hour, here's the lineup for you. JP Morgan's Thomas Kennedy around the table on why investors should rotate out of cash and not on what's happening politically down in Washington, D.C. Retired Air Force Lieutenant General David Depchler on Biden's increasing pressure on Israel, and Dana Peterson of the Conference Board on the data-dependent Fed, consumer confidence, CEO confidence. Lisa, it's starting to pick up. It's starting to pick up. Now, if you're going to get layoffs, big layoffs in America, you need to get to this situation for corporate America, across the board, small, medium, large businesses as well. They've got to sit there and worry about margins. They've got to sit there, worry about margins, and start protecting margins by cutting costs and laying people off aggressively. How close are we to that moment if consumer confidence is building and CEO confidence is building too?
And if you get productivity picking up, so people are maybe more productive and you can increase margins without having to really shift some of the workforce. Honestly, this is the mystery. This is what people are saying, because we just saw Pepsi. Revenue expected to come in light. Profits coming in more. How? I mean, well, you got to think, okay, there's got to be something going on with cost cutting, and we see that after company after company. But, you know, at what point does it really make the headline numbers?
Stocks more broadly at the headline level, positive here by 0.16% on the S&P. Our top story this hour, awaiting US CPI revisions. JP Morgan's Thomas Kennedy expecting the results to have limited impact on the Fed, saying this: Fed rate cuts in March are unlikely. Investors should consider rotating out of cash. Too many investors are using the delayed cutting cycle as a reason to stay in cash. We disagree. Our base case is still a soft landing, with the first Fed rate cut coming in June 2024. Tom's with us now. Morning, Tom.
Good morning.
Let's build on that. Where should they be going? Out of cash to where?
I think the easiest step is just to lock in a 5% yield in a short duration bond. Now, my clients have the goal of compounding wealth over a long horizon, so 5% so attractive in the front end. Let's lock it in for a longer period of time.
Where do stocks fit in?
Oh, stocks have to be the bigger piece of the puzzle here. You two just did, like, for my clients, the most important transition that's happened in the last 3 months, where the Fed's balance within their mandate has shifted dramatically. And the Fed put, as you might say, was out of the money for 2 years, aggressively out of the money, and the Fed just put it back in the money. So even the slightest hint of layoffs, the Fed can cut, and they can cut aggressively. This should give really credible support to earnings. And now the market's trying to decide, when can I really step to those low quality stocks? When can I get aggressive and get excited? In the meantime, stay high quality, and the market is out. That divergence, high quality stocks to low quality stocks, is historic at this point.
You said, stop making this an excuse to not put your cash to work, that maybe the Fed might not cut rates in March. Is anyone using that as an excuse? Because it doesn't seem like it. We make record high after record high.
Yeah, well, within my community at JP Morgan Wealth, one of the biggest pools of global wealth in the world, you still have over 25% of our investable assets in cash and cash equivalents, think like T-bills. Now, that's down quite a bit, but still elevated to prior experience pre-COVID. So I do think there is wood to chop there. And I think we should all acknowledge the cash trade was a great trade. For 2 years, it was a great trade, the right place to be. But now going forward, it's unlikely to be there because of the Fed pivot, because of this disinflationary process, and then what we see in the labor market. You're seeing robust job growth, but you're still getting good indicators that the rebalancing is happening. It's mostly from the supply side. And the thing people aren't talking about enough, real wages are inflecting higher, but they're still well below trend we saw pre-COVID. That creates room for job growth, but not resurgence in inflation.
There's been a big pivot by the Federal Reserve, and yet we hear person after person, including BMO's Earl Davis, talking about the potential for a reignited inflation risk later this year. How does that sort of weigh on your call here? Maybe not as much even on stocks as it is on the duration call.
Yeah, I think we have to respect the January report, right? This was a solid job print. However, Januaries have been head fakes for the last 4 years, so the seasonal adjustments is a struggle. The broader mosaic of the labor market is one where you're getting rebalancing mostly from the supply side. Are we challenging that right now with January? Sure, but quit rates are below where they were. Real wages are below trend. And when you look inside the inflation data, the demand-led inflation maybe from core services is still too high, but not substantially high, and it is coming down. I think with good balance, the Fed has all the evidence they would need to either cut or stay put. I don't see any evidence right now that they should be considering hiking, and I think that's why bond yields have come down. We've cut off that tail that we need to price a probability that they could cut again.
As you know, there's always something to worry about. And we're at that phase of the cycle, we've talked about this, where we're talking about banks we've never talked about before. NYCB is one of those banks.
Yeah.
It's lost a third of its market cap again this week. It's been absolutely hammered since the end of January when they had to increase provisions because of souring commercial real estate loans. How well do you think this market is doing at discriminating between the banks that will have a problem, small, medium, whatever size, and the system that probably won't?
I think that the market is differentiating these banks incredibly well. A simple cut is to take banks with CRE exposure in excess of capital and say, wow, those are at-risk banks versus ones that have CRE loan exposure less than equity. You're talking about a 40% total return dispersion between those two cohorts since March of last year. Now, New York Community Bank flew under the radar for a period of time, given its small nature of its size. I think it's differentiating quite well. At this point, as we look forward, this risk is here, and it's going to be here until rate cuts happen or everybody comes back to the office. And a recent survey from LinkedIn, from one of my ex-colleagues, Karen Kimbrough, 25% of all jobs in America last year were work from home. All jobs added, 25%.
Yeah.
It marries to what we see in our subway data in New York City. We're here. This is a perpetual risk. So until rate cuts happen, this is a risk, but the market's differentiating.
Yeah, Jamie's trying to get everyone back to work. I'm not sure how that's working out for everybody else. This could be a permanent feature that we've got to adjust to. So let's think about it in the following terms. And we've been asking this question. Do you see it as a single name problem, a sector problem that eventually becomes a broader market problem because it's an economic issue?
Yeah.
That ultimately they have to tighten lending standards, and you're going to see their ability to finance the economy. It's going to get diminished in the year to come. How do you frame that?
I think we frame it as a natural credit cycle that many investors on Wall Street haven't seen for 40 years, where the Fed has hiked rates, we have all locked in interest rates, and we're going to have to deal with that higher interest rate environment. Cohorts of the economy are not going to be able to survive. You guys mentioned high yield spreads are really tight. Yeah, but as high yield spreads have tightened, CCC rated spreads have actually widened. It's quite an anomalous environment. What is the high yield investing community saying? Yeah, we feel good about this cohort, but that cohort's going to have an issue. And when we look in our own private credit direct lending data, we see similar types of dispersion. So I just think we're going to go through a credit cycle, and that's maybe helps explain
How unusual is that, though, historically, to go through a credit cycle, come out the wrong end of it, and see credit spreads at 320 and equities at all-time highs?
It's quite common to be walking into a credit stress scenario and see spreads very tight.
To walk into it, yes.
Yeah.
I'm talking about coming through it out the other side.
Well, we don't know exactly what that's going to look like here, John. I mean, when you look back in history, you do get credit. You can get credit cycles and still see an economy perform very well. It's just you have had a decade of low interest rates where people have been able to survive, or businesses, and maybe that's going to be a reckoning. So I think, how do I frame this?
Yeah.
I can be invested in the stock market, favor cash flowing, high quality businesses, and still find distressed opportunities, whether it be in real estate or in smaller businesses.
I just know the Lisa worry. I could see the Lisa worry playing out.
Oh, yeah?
You know, have we really played the price to go from 0 to 550? And was the price for that really just a bad year for tech stocks in 2022?
No, I agree with what you're saying, and I'm trying to draw that out. There are these businesses that are going to have...
Carry on, but I'm thinking it. Go on.
I'm reading your facial expression here, too.
Well, there are other things going on, too.
I think that we have not felt all of that worry and all of the consequence yet, John. But the point is that rates are at 550, and now they've come down to a place where refinancing activity can happen. And think about that in a single B-rated credit type of idea.
What I'm struck by is that people have walked through all the worries so much that they think that they understand them. And that to some degree, maybe they have. There is a differentiation.
Yeah.
So that's really the key. Have people really internalized the worry, chewed over it, spent hours up at night, figured out how they want to price it, and then it's fairly priced in markets right now so people can discount it. That seems to be where people are at, and I find that pretty interesting.
Tom, final word?
I think from a final word perspective, we have to acknowledge that this cycle has been wildly different. The Fed has pivoted, and now they are a support network for growth and earnings going forward. And for my clients, I want them to take some of that cash that they have sat on and loved and get invested in a world where they can compound their wealth for a long period
Into
of time.
some higher fee funds and stuff like that.
That was not something I would say.
Just something I said.
Right here.
Tom,
You might say
Tom
somewhere
Kennedy,
else.
JP Morgan. Tom, it's good to see you. Appreciate it, as always, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Russian President Vladimir Putin says he has not yet achieved his objectives in Ukraine. Putin told former Fox News host Tucker Carlson that he would be open to negotiations if the U.S. were to stop sending weapons to Ukraine. The Russian president also discussed jailed U.S. journalist Evan Gershkovich of the Wall Street Journal, saying he believes an agreement could be reached to secure his release. The Supreme Court appears ready to keep Donald Trump on this year's presidential ballot. Justices cast doubt over a suit to disqualify him over his role in the January 6th insurrection. Both liberal and conservative justices questioned whether the Colorado State Supreme Court had power to exclude Trump on the grounds of the 14th Amendment. The court is set to reach a ruling on an expedited basis, meaning it could come in the next several weeks. The European Central Bank is warning lenders that they may face higher capital requirements to cover commercial real estate risks. The watchdog is now placing greater emphasis on CRE risk, though individual requirements may only apply next year. Commercial real estate fears have bubbled up once again, this time in Europe, Japan, and most notably, New York Community Bank. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Equities right now positive by 0.15% on the S&P. Up next on the program, President Biden lashing out.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine.
That conversation continues up next. Live from New York, this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show